Do you see the man on the left? He's a leading figure of mercantilism, a theory that was eventually debunked by economists like the famous Adam Smith, who spoke about the invisible hand of the market. Mercantilism proved to be a flawed theory, particularly in terms of long-term economic growth. On the right is Donald John Trump, the current president of the United States, and a man who brought this failed theory back into the 21st century. The only thing missing from the historical parallel is the colonies he would need to export to, which, of course, isn't going to happen in today's world. So let's take a more comprehensive look at the economies that determine world trade, what the experts are saying, and at the end I'll add my own personal key points and opinions. Hello, before we begin, a brief disclaimer. I am not a global expert, and I don't guarantee the complete accuracy of the data or the predictions. I try to follow trends, read many sources, and look for connections. It's possible that some of the data isn't entirely accurate or that I've slightly misunderstood it. Therefore, I ask you to focus mainly on the story and the development, not on the exact numbers. In my personal opinions, in the end, there won't be any calculations or models, but rather common sense, an observation and logical reasoning. I don't want to compare myself to the experts. My goal is to point out interesting things and open up a discussion. At the same time, I apologize for the visuals. I'm just starting out, and it takes a lot of time. So, later in the visuals, you'll see more historical parallels, some of which may be provocative, some interesting, and some maybe even funny, all with the goal of showing what's happening now. These are not new things. Those interested in history might enjoy them. At the same time, if you support me by liking or commenting, I'll consider leaving the visualizations to people who can do them better. Thank you for your understanding. Let's get started. So it's the year 2024. After all the unprecedented shocks, from the pandemic and the energy crisis to high inflation, you might have thought we were heading for a catastrophe. But hold on. The global economy has shown some quite remarkable resilience. This is despite central banks all over the world having to intervene decisively and dramatically raise interest rates to tame that rampant inflation. This resilience, by the way, is partly due to how real estate markets adapted, which somewhat softened the short-term impact of the interest rate hikes. But, not all resilience is the same. When we look at the bigger picture, we see steady, but let's be honest, slow growth. And what's even more important for you is the divergence, the unevenness. Not all regions are developing at the same pace. The International Monetary Fund, or IMF, in its April 2024 forecast, predicted that the global economy would grow at a rate of 3.2% in both 2024 and 2025, which, by the way, is the same rate as in 2023. A slight acceleration is expected in advanced economies, with a projected increase from 1.6% in 2023 to 1.7% in 2024 and 1.8% in 2025. In contrast, in emerging markets and developing economies, a slight slowdown is expected, from 4.3% in 2023 to 4.2% in 2024 and 2025. And what's most important? The 5-year global growth forecast at 3.1% is the lowest in decades. Imagine that. This isn't just some cyclical slowdown. It suggests there are structural problems beneath the surface that are holding back our long-term potential. We're talking about hidden vulnerabilities that could show up later. The World Bank, in its Global Economic Prospects report from June 2024, also predicted that global growth would stabilize at 2.6% in 2024. However, this growth is significantly below the average of 3.1% in the decade before the COVID-19 pandemic. The Organization for Economic Cooperation and Development, or OECD, in its latest economic outlook from June 2025, projected a slowdown in global growth from 3.3% in 2024 to 2.9% in both 2025 and 2026. This slowdown is expected to be most pronounced in the United States, Canada, Mexico, and China. And what about inflation? That's a topic that's been troubling us for the past few years. Global inflation is projected by the IMF to gradually fall from 6.8% in 2023 to 5.9% in 2024 and 4.5% in 2025. The World Bank expects global inflation to ease to 3.5% in 2024 and 2.9% in 2025, but at a slower pace than originally anticipated. And why is this important? because a slower drop in inflation means that the interest rates which are so constricting our economy will remain higher for longer. This will burden loans, investments, and simply the entire economy. Now that we have that macroeconomic framework, let's look at the lifeblood of the global economy: international trade. Let's face it, the volume of world merchandise trade was almost stagnant in 2023, representing the weakest performance in 50 years outside of global recessions. This is an alarming number when we consider that open trade has long been considered an engine for growth. Despite this, however, there is some optimism. The World Bank forecasts that the growth of global merchandise trade will increase to 2.5% in 2024 and 3.4% in 2025. The World Trade Organization, or WTO, revised its forecast for merchandise trade growth to 2.7% in 2024 and 3.0% in 2025. Trade and services saw an 8% increase in the first quarter of 2024, and the total value of global trade is expected to reach a record of almost $33 trillion in 2024. But this recovery is happening in the shadow of escalating trade tensions and immense geopolitical uncertainty, and that is what's truly worrying. Think about the ongoing conflicts in the Middle East and the war in Ukraine. These are not just regional problems. They are factors that can sharply increase energy prices, trigger inflation, and directly affect business and consumer confidence worldwide. The IMF has repeatedly warned us that if these trade wars and uncertainties escalate, we will have serious problems with growth, both in the short and long term. And what's most concerning is that the number of new trade restrictions remains significantly above pre-pandemic levels, even though it has fallen from a historic high in 2023. They still point to a trend that is the opposite of global integration. The resilience of the economy is paradoxical. We are able to adapt to shocks like interest rates, but the long-term structural problems resulting from tension and fragmentation are undermining our potential. We are in an environment where the very foundations of the global trading system are changing. So who are the main players in this, let's call it, arena of world trade? We have three giants: the United States, China, and the European Union, each with its own strategy, its own levers, and its own vulnerabilities. And their interactions define the entire game. The United States, as the world's largest importer of goods in 2024, with a 15.9% share of total world imports, and also the third largest exporter with a 10.4% share, is pursuing a policy that we could call America First. This philosophy often manifests in very aggressive tariffs. Take, for example, the 100% tariffs on Chinese electric vehicles, or EVs, from May 2024, which represents a significant increase from 25% in 2018. These tariffs apply to all imports of Chinese EVs, regardless of the level of state subsidies. In addition, the U.S. has banned the export of high-end technologies, such as advanced chips, to China for national security reasons. The consequences of this policy are noticeable for U.S. companies operating in China, as they are reporting record-low plans for new investments and declining confidence in profitability, with uncertainty in U.S.-China relations and tariffs being their main concerns. The IMF also noted that excessively large public deficits in the U.S. are contributing to growing trade deficits. China was the world's largest exporter of goods in 2023, with a 17.5% share of total world exports, and the third largest importer, with a 12.8% share. For the European Union, China is the largest partner for goods imports, at 21.3% in 2024, and the third largest for exports, at 8.3% in 2024. China's current account surplus expanded by 0.24% of global GDP in 2024, which the IMF considers to be excessive and reflective of domestic macroeconomic imbalances. China's industrial policy, driven by massive public subsidies, has led to excess export capacity. In response to EU tariffs on EVs, China introduced preliminary anti-dumping duties on cognac from the EU, ranging from 38 to 39%, and launched an anti-subsidy investigation into dairy products and an anti-dumping investigation into pork exports from the EU. In addition, China introduced new global export licensing requirements for critical raw materials, such as rare earths, starting in April 2025. China holds a near monopoly on 17 essential metallic elements, controlling approximately 60% of the world's supply and 90% of global processing capacity. And then there's our European Union. We are, let's be honest, in a position between a rock and a hard place. We are the second largest importer and exporter of goods in the world. In 2024, the total volume of goods trade between the EU and China reached €731 billion, with the EU facing the largest bilateral trade deficit in the world at €304 billion with China. The EU launched an anti-subsidy investigation into Chinese EVs in October 2023 and announced preliminary tariffs in July 2024. The EU is concerned about the potential for Chinese excess production to be redirected to its market as a result of increased U.S. tariffs. Data from March and April 2025 showed that Chinese exports to the EU increased by 10.3% and 8.3%, while exports to the U.S. decreased by 21% during the same period. Europe has become a battlefield in the technological war between the U.S. and China, facing conflicting pressures from both sides. The EU is striving for economic neutrality, but is also under pressure from the U.S. for closer alignment on issues like critical raw materials and economic security. This asymmetrical dependence of ours simply makes us vulnerable, especially when we realize that China holds a near monopoly on critical raw materials. And why are these tensions so intense and persistent? There are structural factors that define this game: tariffs and trade barriers. In May 2024, the United States imposed a 100% tariff on Chinese electric vehicles, or EVs, a significant increase from 25% in 2018. The European Union has taken a different approach. It began an anti-subsidy investigation into Chinese EVs in October 2023 and announced preliminary tariffs in July 2024, which vary depending on the level of subsidies. China reacted to the EU's tariffs by introducing preliminary anti-dumping duties on cognac from the EU, ranging from 38 to 39%, and launched investigations into subsidies on dairy products and pork. The IMF suggests that higher tariffs in deficit countries like the US have only a, quote, small impact on global imbalances because they act as a negative supply shock. However, it warns that the damage to the global economy will be long-lasting. The OECD emphasizes that further trade fragmentation could intensify the growth slowdown. One of the main causes of tension is state subsidies and overcapacity. The EU is primarily concerned about the, quote, damage already being done to European car manufacturers by the influx of cheaper and unfairly subsidized Chinese EVs. The European Commission's investigation in July 2024 found evidence of extensive subsidies. The IMF clearly states that China's surpluses and the US's deficits reflect domestic macroeconomic imbalances. Then, technological competition between the US and China has intensified significantly in areas like semiconductors, 5G networks, artificial intelligence, and quantum technologies. Since 2019, the US has been imposing restrictions on Chinese tech companies and on advanced chip exports to China, which has sparked a chip war. China holds a near monopoly on 17 essential metallic elements that are critical for digital and green technologies, controlling about 60% of the world's supply and 90% of global processing capacity. Intellectual property and market access is a primary reason for U.S. tariffs is to pressure China to end its practice of forced technology and intellectual property transfer. WTO arbitrators in July 2025 confirmed that Chinese courts had banned patent holders from enforcing their rights outside of China, which violated TRIPS rules. China was given 90 days to remedy the situation. China has accused the EU of creating too many regulatory hurdles that, according to Beijing, hinder Chinese trade and investment. And how does all this manifest in the real world, in our economies, and in our wallets? It has widespread and very complex consequences. Further trade fragmentation could cause significant disruptions to cross-border supply chains. The technological competition between the US and China is already disrupting global supply chains, especially in the semiconductor sector. American companies in China are reporting negative impacts from US export controls, including lost sales. The World Bank suggests that the global economy is stabilizing, but at the same time, it predicts that global growth in 2024 to 2026 will be well below the pre-COVID-19 decade average and the slowest pace since the 1960s. The OECD projects that higher trade costs in countries raising tariffs will push up inflation. The IMF states that an escalation of trade wars could further hinder both near-term and long-term growth prospects. The OECD forecasts a slowdown in global growth from 3.3% in 2024 to 2.9% in 2025 and 2026. For the U.S., GDP growth is expected to decline from 2.8% in 2024 to 1.6% in 2025, with about 0.4% of that decline attributed to the effects of tariffs and related market disruptions. Political uncertainty weakens trade and investment, saps consumer and business confidence, and curbs growth prospects. Investment has been declining since the global financial crisis. U.S. companies in China are reporting record-low plans for new investments and declining confidence in profitability, with more than half having no new investment plans in China this year. European companies in China are also cutting costs and limiting investment plans. The phenomenon of trade diversion is also significant. The EU is concerned about the potential diversion of Chinese overcapacity, as Chinese exports to the EU have risen while exports to the US have fallen due to US tariffs. Data from March and April 2025 showed that Chinese exports to the EU increased by 10.3% and 8.3%, while exports to the US fell by 21% in the same period. So the world is fragmenting. The era of hyperglobalization is ending, being replaced by reglobalization, where national security and strategic dependencies are more important than the lowest price. The world is dividing into rival economic blocs. The real cause of the tension is deep domestic problems, excessive deficits in the U.S., and state-directed overproduction in China. Tariffs don't solve these problems. They just increase inflation and harm everyone. The international arbiter is weakened. For example, the WTO are losing authority because major powers, especially the U.S., are prioritizing unilateral actions. This creates uncertainty and a world without clear rules. All major institutions, including the IMF, World Bank, and OECD, agree on the solution: restore international cooperation and begin to address domestic economic problems, such as fiscal discipline in the U.S., supporting consumption in China, and investing in the EU. Governments should reduce political uncertainty and promote investment, and create a stable and predictable political environment to restore business confidence and encourage investment. Diversify supply chains and strengthen resilience. To reduce vulnerability to geopolitical shocks, countries should actively support the diversification of suppliers and invest in domestic critical capacities. Finally, we need a coordinated approach to technological competition. Instead of unilateral measures, the U.S. and the EU should strive for a coordinated approach to addressing concerns about technological dominance and protecting intellectual property. To understand the complexity of the topic, we also have to talk about what tariffs are and their history. We can think of three basic types of tariffs. First, there are ad valorem tariffs, which are calculated as a percentage of the value of imported goods. Imagine you're importing a $100 item with a 10% ad valorem tariff. That's $10. They're flexible and adapt to changing prices. Then there are specific tariffs, which are fixed. For example, $5 for every kilogram of imported coffee. These provide predictability. And finally, compound tariffs, which are a combination of the two. But besides these technical types, there's also the concept of punitive tariffs. These are tariffs that are exceptionally high. A government imposes them either to protect its domestic producers or as a retaliation if it believes another country is playing unfairly. And here, we can clearly see that tariffs aren't just a dry economic tool, but also a powerful weapon of economic coercion and geopolitical influence. The choice of tariff type is not random, it's a strategic political decision. And why are we talking about this? Because understanding this tool is key to understanding this topic. We're going to trace how these tariffs have been used from early economic doctrines like mercantilism to today's complex multilateral frameworks. We'll focus on the period before 2024 and examine the most significant trade disputes between the United States and the European Union, and of course, between the United States and China. We'll look at specific tariffs, the reactions and countermeasures, and the broader macroeconomic consequences for global trade, for supply chains, and for overall growth. So let's go back in history. Imagine 16th to 18th century Europe. The economic system of mercantilism reigns. Its main goal was to strengthen state power. How? By accumulating gold and silver. And how to achieve that? By restricting imports and maximizing exports. High tariffs, especially on finished products, were the alpha and omega of policy at the time. They protected domestic industries and helped accumulate monetary reserves. We have specific examples. Jean-Baptiste Colbert, in France, the Controller General of Finances for King Louis XIV, systematically revised the tariff system to restrict imports. In Britain, there were the Navigation Acts, which were meant to exclude foreign merchants and restrict colonial trade for the benefit of the mother country. And did you know that this also contributed to the friction that led to the American Revolution? In the United States, from the Civil War until the mid-20th century, there was the American School, a philosophy that had similar principles and was characterized by selective high tariffs, especially from 1861 to 1932, to protect industry. Mercantilists believed that world trade was a fixed quantity. If one gains, another loses. This approach, while historically distant, we can see persists in modern protectionist impulses. That's the zero-sum approach that is still present in current trade wars. And it is from this period that one of the most infamous examples of protectionist policy and its devastating consequences comes. The Smoot-Hawley Tariff Act of 1930 in the United States. This act drastically increased tariffs on over 20,000 imported goods. It was ostensibly meant to protect American farmers and manufacturers during an economic downturn, but it proved to be catastrophic. It triggered widespread retaliatory tariffs from other nations. It led to a dramatic drop in the volume of international trade, worsened the Great Depression, deepened unemployment, and reduced global purchasing power. Fortunately, the disastrous lessons of the Great Depression and the Second World War spurred a global consensus. Open, multilateral trade is essential to support growth and peace. And it only took the world 150 years to realize that Adam Smith was right. The wealth of a nation doesn't come from imports or exports, but from the ability to identify people's talent and turn it into a successful product or service. Instead of proudly pushing the idea that we can make everything ourselves and returning to the illusion of absolute self-sufficiency, it is wiser to focus on human capital and what we do more efficiently and better than others. I'm interested in how you see this. Let me know in the comments. And if you like this content, I would appreciate a like or a subscription. Now, back to the story. And so, the GATT, the General Agreement on Tariffs and Trade, was created in 1947. It was a temporary multilateral agreement intended to provide a framework and a forum for negotiating the reduction of trade barriers, especially tariffs. GATT operated for almost half a century. Through 8 trade rounds from 1948 to 1993, it successfully facilitated reciprocal tariff reductions, lowering them to about 20% of their average level from 1930. Parallel to the GATT, the International Monetary Fund, or IMF, was also founded in 1945 as part of the Bretton Woods system, with the mandate to promote open and stable trade policies. The World Bank Group also emerged in the post-war period, supporting an open, rules-based trading system. And the culmination of this era was the World Trade Organization, or WTO, which formally replaced GATT on January 1, 1995, after the conclusion of the Uruguay round, which lasted from 1986 to 1994. The WTO significantly expanded GATT's scope beyond traditional tariffs and quotas to new areas such as trade and services, intellectual property rights, and food safety. It also established a more robust and legally binding dispute settlement mechanism. The progression from the temporary GATT to the formal WTO represents a profound shift in global governance, driven by the recognition that fragmented cooperation was insufficient to manage increasingly complex global trade. Now we can get right to the period after the U.S. presidential elections in 2016. It marked a significant shift in global trade policy. We are witnessing a revival of protectionism, especially from the United States. And this poses a significant threat to global economic stability. The latest OECD Economic Outlook from June 2025 predicts a weakening of global economic prospects. Global growth is expected to slow from 3.3% in 2024 to 2.9% in both 2025 and 2026. This slowdown, by the way, is expected to be most concentrated in major economies, such as the United States, Canada, Mexico, and China. The OECD explicitly warns that further trade fragmentation, driven by new tariff increases and retaliatory measures, could deepen the slowdown and disrupt supply chains. And yes, such measures also contribute to inflationary pressures. The International Monetary Fund, or IMF, has also issued serious warnings. Trade disputes, along with other geopolitical shocks, have the potential to destabilize the entire global economy and reduce stock returns. An IMF analysis from April 2025 suggests that the effective U.S. tariff rate has surged above the levels reached during the Great Depression. Imagine that. We are at levels reminiscent of the crisis of the 1930s. The rise in effective tariff rates, along with warnings from international organizations, suggests that this is not just a series of isolated disputes, but a fundamental challenge to the post-war order of trade liberalization. We are witnessing a broader trend of deglobalization, or at the very least, a significant re-evaluation of global economic integration. Let's now look at the specific hotspots of these tensions. We'll start with transatlantic relations. Although the U.S. and the EU are the world's largest economies and each other's most important trading and investment partners, the EU was the U.S.'s largest trading partner for goods in 2024, with a volume of an incredible 865 billion euros. They have experienced significant friction, especially during the Trump administration. What were the key U.S. tariffs imposed on the EU? In 2018, the Trump administration used Section 232 of the Trade Expansion Act of 1962, a national security measure, to impose tariffs of 25% on steel and 10% on aluminum imports from the EU. This was extremely controversial because the national security justification was used for what many perceived as pure economic protectionism. Tariffs on cars have also been a persistent point of contention. Historically, the U.S. has charged a 2.5% tariff on passenger cars from the EU, while the EU imposed a 10% tariff on passenger car imports from the U.S. President Trump later increased the U.S. tariff on all foreign vehicles to 25%. Let's not forget about agricultural products. Trump often criticized the EU, claiming it was not buying American agricultural products. However, data from 2024 showed that the EU was the fourth largest buyer of American agricultural products, purchasing goods worth $12.8 billion US. And there are still new tariffs being threatened. In 2025, President Trump hinted at tariff rates of up to 200% on foreign pharmaceuticals unless companies move production to the U.S. More broadly, in early April 2025, the U.S. administration imposed a blanket 20% tax on all EU goods, with plans to raise it to 30% if a new trade deal was not reached by August 1, 2025. This weaponization of national security is reshaping the boundaries of legitimate trade policy and forcing trade partners to react outside conventional frameworks. How did the EU respond? As a unified trading bloc, the European Union has responded with a combination of retaliatory measures, new policy tools, and diplomatic efforts. In a direct response to the U.S. steel and aluminum tariffs in 2018, Brussels imposed its own tariffs on specific American exports, including motorcycles, jeans, and bourbon. In the face of potential new U.S. tariffs, EU leaders warned of imposing higher tariffs on hundreds of American imports, identifying a package of U.S. goods worth $84 billion for potential retaliation. While the Biden administration tried to de-escalate tensions, it replaced tariffs with import quotas. However, efforts to negotiate a broader clean steel agreement failed, primarily because the U.S. demanded an exemption for its steel companies from the EU's Carbon Border Adjustment Mechanism, or CBAM, which Brussels refused to grant. And here comes the interesting development. The EU created new tools. One of the most significant is the Anti-Coercion Instrument, or ACI, also known as the Trade Bazooka. Proposed in December 2021, adopted in November 2023, and effective from December 2023, the ACI is a defensive and deterrent tool designed to prevent economic coercion by creating economic sanctions for countries that illegitimately interfere with the EU's political decisions. It allows the EU to react with measures such as tariffs, restricting access to programs and financial markets, without needing the unanimous consent of all member states. It was motivated in part by U.S. sanctions on Nord Stream 2 and China's coercion against Lithuania when Taiwan opened its representative office in Lithuania. The EU also moved forward with its CBAM, which will apply import duties on carbon-intensive products. In addition to external measures, the EU is also strengthening its single market, which includes 27 plus 3 European countries and over 450 million consumers, representing almost 18% of the global economy, to increase its resilience. And if that weren't enough, the EU also established the Single Market Emergency and Resilience Act, or IMERA. In diplomacy, the EU consistently uses the WTO's dispute settlement mechanisms. And recognizing the paralysis of the WTO's appellate body due to the blocking of appointments by the US, the EU, along with other WTO members, established the Multi-Party Interim Appeal Arbitration Arrangement, or MPIA, in April 2020. This entire complex EU response indicates a strategic adaptation to open strategic autonomy. What were the economic consequences of these disputes? The U.S. trade deficit in goods and services with the European Union exceeded $130 billion in 2022. In 2024, the U.S. imported goods worth approximately $606 billion from the EU, while exporting products worth about $370 billion. The proposed U.S. tariffs, such as a 30% blanket tax on EU goods, could wipe out a large portion of trade with the U.S., and lead to higher costs for consumers. The disputes also led to increased volatility in financial markets. Specific EU sectors that are heavily dependent on exports to the U.S., such as the automotive, pharmaceutical, and machinery industries, face particular risks. And here's the interesting indirect consequence: the risk of a second shock from China. Higher U.S. tariffs on China could divert Chinese exports to the European market, which would intensify competition for EU manufacturers. Estimates suggest a loss of 8,000 to 10,000 jobs for every €1 billion reduction in exports. Now let's look at the most significant trade war of recent years, the one between the United States and China. The economic conflict began in January 2018 under the administration of President Donald Trump, with the goal of forcing China to change what the U.S. called long-standing unfair trade practices and intellectual property theft. Initial tariffs in 2018 were between 20% and 50% on solar panels and washing machines. This was followed in March 2018 by 25% tariffs on steel and 10% on aluminum imports from all countries. A key escalation occurred in March 2018 when the U.S. Trade Representative's Office, or USTR, launched a Section 301 investigation, which led to proposed tariffs on $50 to $60 billion worth of Chinese goods. By July 2018, 25% tariffs were imposed on $34 billion of Chinese goods, later expanded by another $16 billion. And by September 2018, a 10% tariff was applied to another $200 billion of Chinese goods, which was set to increase to 25% by the end of the year. And the escalation continued in 2019, when the 10% tariffs on $200 billion of Chinese goods were raised to 25% in May. By August 2019, the U.S. announced an additional 10% tariff on the, quote, remaining $300 billion of goods, while existing tariffs on $250 billion were increased from 25% to 30%, and on $300 billion from 10% to 15%. And what about the Biden administration? It's interesting that it largely maintained the Trump-era tariffs and introduced additional fees on specific Chinese goods. In May 2024, tariffs on solar cells were doubled, and tariffs on lithium-ion batteries for electric vehicles were more than tripled. These increases were finalized in September 2024, reaching 100% on EVs, 50% on solar cells, and 25% on batteries for EVs, critical minerals, steel, and aluminum. This continuity of tariffs across two administrations and their expansion into high-tech sectors suggests that the conflict is not just a dispute over trade deficits, but a deeper, long-term strategic competition for technological dominance. How did China respond to this? It reacted with a robust and multifaceted approach. It consistently imposed its own tariffs on American goods. For example, in April 2018, China imposed 25% tariffs on American aluminum, aircraft, cars, pork, and soybeans, and 15% on fruit, nuts, and steel pipes. By April 2025, China announced a significant increase in tariffs on all U.S. imports, from 84% to 125%. In addition to tariffs, China also adopted a range of non-tariff measures. These included launching antitrust investigations against American companies, suspending certificates for chicken exports, introducing export controls on critical rare earth minerals, where it holds a near monopoly on 17 essential metallic elements and controls about 60% of the world's supply and 90% of global processing capacity, and placing U.S. defense firms on an unreliable entities list. It also suspended approvals for new Chinese investments in the U.S. and even banned the import of American films. China strategically prepared for a long-term conflict by diversifying its trade relationships. China's exports to ASEAN countries increased from 12.8% in 2018 to 16.4% in 2024, and to countries in the Belt and Road Initiative, or BRI, from 38.7% to 47.8%. At the same time, Chinese exports to the U.S. decreased from 19.2% of total exports in 2018 to 14.7% in 2024. China also reduced its dependence on agricultural imports from the U.S. For example, the share of American soybeans in the Chinese market fell from 40% in 2016 to 21% in 2024, and U.S. corn exports to China dropped from $2.6 billion in 2023 to $561 million in 2024. It turned to alternative suppliers like Brazil, Argentina, and Australia. What is the impact of this U.S.-China trade war? Surprisingly, while it significantly affected bilateral trade flows, it didn't fundamentally change the overall bilateral U.S. trade deficit with China. However, we have seen trade diversion. Countries like Mexico, Brazil, Vietnam, Thailand, and South Korea have emerged as winners as they've profited from new trade opportunities. The costs of the tariffs were largely borne by American consumers through higher prices or were absorbed by importing companies. The macroeconomic consequences of this trade war have been felt globally. The OECD and the IMF have repeatedly warned of a weakening of global economic prospects. The OECD predicts a slowdown in global growth from 3.3% in 2024 to 2.9% in 2025 and 2026. The IMF states that increased tariffs and uncertainty will significantly slow global growth, with its baseline forecast lowering global growth to 2.8% for this year and 3% for next year, representing a cumulative reduction of 0.8 percentage points. At the same time, global inflation is expected to increase by about 0.1 percentage points per year due to higher trade costs. Regarding the impact on GDP, in the U.S., GDP growth is projected to fall from 2.8% in 2024 to 1.6% in 2025 and 1.5% in 2026. The IMF estimates that the tariffs have reduced U.S. GDP growth by 0.4 percentage points, with the overall growth estimate for this year being 1.8%. China also saw a decline in GDP growth, with its growth forecast reduced to 4%. Overall, tariffs are expected to deduct about 0.3% from global GDP in the short term. Global trade growth is projected to decrease more than production, to 1.7% in 2025. Tariffs and trade disputes lead to increased volatility in financial markets. The IMF warns that shocks, including trade disputes, can reduce stock returns by more than 1% per month. Uncertainty and higher costs erode economic dynamism, leading to a postponement of investments. And one of the most significant systemic consequences is the paralysis of the WTO's appellate body. Since 2016, the United States has been blocking the appointment of new members, which led to the appellate body ceasing to function in December 2019. This means that appeals cannot be heard, and the losing party can appeal a panel's report into legal limbo. The number of cases submitted to the WTO has plummeted to about a third of the level before the collapse of the appellate body. This breakdown of the highest trade court seriously undermines the WTO's ability to effectively enforce global trade rules and settle disputes. The evolution of tariffs shows us the cyclical nature of global trade policy, which constantly moves between protectionism and liberalization. Historically, from mercantilist endeavors to the catastrophic consequences of the Smoot-Hawley Tariff Act, it has been shown that unilateral protectionist measures are often counterproductive and lead to a broader economic decline. The post-war era, with the GATT and the WTO, represented a commitment to a multilateral, rules-based trading system that contributed significantly to global growth and integration. However, the period after 2016 has witnessed a significant departure from this consensus, especially through extensive trade disputes between the US and the EU and the US and China. These conflicts, driven by concerns over trade deficits, intellectual property theft, and broader strategic competition, led to the imposition and retaliation of tariffs and non-tariff barriers. The use of national security as a justification for tariffs by the US represents a significant challenge to WTO rules. The responses of the EU and China have not just been reactive but strategic. The EU has developed new tools, such as the ACI and CBAM, and strengthened its internal market to achieve open strategic autonomy in an uncertain environment. Meanwhile, China has focused on self-sufficiency and the diversification of trade relationships to reduce its vulnerability to US pressure. The macroeconomic consequences are clear: a slowdown in global growth, increased inflation, supply chain disruptions, and heightened uncertainty. Surprisingly, while bilateral trade deficits have remained largely unchanged, the trade war has led to trade diversion, which has created opportunities for bystander countries. And what do you think? Does the existence of a body to decide on economic disputes even make sense if it's a superpower against which real sanctions cannot be enforced in practice? If an enforcement mechanism is missing, isn't it just symbolism? Write me your opinion in the comments. And if you're interested in these topics, I'd appreciate a like or a subscription. Now, back to the story. The recommendations of global organizations are clear and once again talk about the same things. We must support international cooperation and a multilateral trading system. Governments should actively promote dialogue and cooperation within the WTO and other multilateral forums. It's crucial to resolve the stalemate in the WTO's appellate body to restore its functionality and credibility. We must address domestic macroeconomic imbalances. The US should prioritize fiscal consolidation, while China should rebalance its economy towards domestic consumption. The EU should increase public investments in infrastructure. We need to reduce political uncertainty and support investments. Governments should create a stable and predictable political environment to restore business confidence and promote investments. We also need to diversify supply chains and strengthen resilience. To reduce vulnerability to geopolitical shocks, countries should actively support the diversification of suppliers and investments in domestic critical capacities. We should focus on structural reforms. To strengthen long-term growth potential, comprehensive structural reforms are needed, aimed at improving productivity, innovation, and market access. Finally, we need a coordinated approach to technological competition. Instead of unilateral measures, the US and the EU should strive for a coordinated approach to addressing concerns about technological dominance and the protection of intellectual property. Remember, when expert organizations repeatedly emphasize something, it has a much deeper meaning. They're not just empty words. For example, as far back as 2000, the European Commission itself, in its Green Paper titled "Towards a European Strategy for the Security of Energy Supply," explicitly stressed the need to diversify energy and sources. In the same year, the International Energy Agency also warned in its document Regulatory Reform, European Gas, where it pointed to the fragility of dependence on a limited portfolio of contracts with external suppliers. And we know how it turned out when these warnings were ignored. Let's remember the failure of the ambitious Nabucco project, the Georgian crisis in 2008, and the subsequent annexation of Crimea and the war in Ukraine in 2014, which already indicated serious problems with energy dependence and security. These events were just a prelude to the full-fledged energy crisis that we felt in full force after 2022. If we had listened to 20-year-old analyses and warnings, and also believed the warnings about Russia's invasion of Ukraine, at the very least, European leaders would have listened to foreign experts and various other institutions around the world. Although we don't know where the secret security agencies in the EU were during this time, or whether they reported the high risks of a Russian invasion of a neighbor, the EU could have reacted faster and more decisively, and meaningless projects like Nord Stream 2, which wasn't even launched, especially due to US sanctions, would not have been built. In that case, Germany likely pursued only its national interests, while major reforms regarding Germany's economic positioning in the global economic world remain unchanged, even though it continues to depend on cheap energy. Let's remember the Weimar Republic after the First World War. In less than 20 years, it faced a host of crises and problems. This is exactly what it has in common with the European Union when we talk about the various crises over the last almost 2 decades. We started with the global financial crisis in 2008 and 2009. We went through the Eurozone sovereign debt crisis from 2010 to 2015. Then came the COVID-19 pandemic from 2020 to 2022. And finally, the war in Ukraine from 2022 to 2024. Each of these events left deep, lasting marks on our global growth, productivity, and international relations. Understanding these connections is key if we really want to assess where we are today and how we should react in the future, up to the current year 2025, which I would describe as a crisis of America's general knowledge. For example, when it comes to the belief that tariffs are paid by countries. Let's start with the biggest shock of this period, the global financial crisis in 2008 and 2009. It was the most serious crisis the global economy had experienced in over 70 years. Its roots: excessive risk-taking in the U.S. housing market, complex mortgage-backed securities, and extremely high leverage of financial institutions. And we saw similar imprudent practices in some European countries, such as Iceland, Ireland, and Spain. But here let's look at a key, often overlooked point. It's not just about the greed of banks. The roots of the crisis in the U.S. also stemmed from political decisions that pressured banks to provide mortgages to less creditworthy clients. There were affordable housing goals and legislation that, although well-intentioned to expand homeownership, in practice prevented banks from simply saying no, even if the client was risky. This led to the mass creation of toxic assets, which were just a matter of time before they exploded. This is something that is surprisingly rarely talked about in mainstream public discussions. There were 2 laws: the Community Reinvestment Act, or CRA, of 1977, and Affordable Housing Goals. Because of these laws, banks were pressured, and I'll put this simply, to bundle all mortgages, including the risky ones, which meant they needed some kind of valuation or insurance. This is how the well-known subprime mortgages came about. Because banks trade in debt, and a mortgage is also just debt. The immediate impact was drastic. When the investment bank Lehman Brothers collapsed on September 15, 2008, it triggered a worldwide fight for liquidity. Credits froze. Cross-border trade collapsed dramatically. It quickly spread to countries that were not directly affected by the banking crisis. As a result, 91 economies, representing about 2/3 of global GDP, saw a decline in output in 2009. World trade also dropped dramatically in the same year, especially due to a sharp drop in demand and the drying up of trade financing. And the long-term consequences of the global financial crisis? They persist to this day. Even 10 years after the crisis, we still saw persistent output losses globally. The crisis led to a significant slowdown in the growth of total factor productivity, an economic term that expresses efficiency, which accounted for more than half of the decline in growth in both advanced and emerging economies. Since 2008 and 2009, the medium-term outlook for global growth has been constantly revised downwards. Forecasts suggest that without timely policy interventions, global growth will reach only 2.8% by the end of the decade, which is a full percentage point below the pre-pandemic average of 2000 to 2019. Public debt worldwide has surged. The median ratio of government debt to GDP rose from 36% before the crisis to 51% after the crisis. This crisis was not just a cyclical downturn, it was a structural break that fundamentally changed the trajectory of global economic growth. It created an era of lower productivity, an increased debt burden. And what's most important for our understanding of the connection? The political responses to the global financial crisis, while mitigating the immediate collapse, unintentionally laid the groundwork for future vulnerabilities. The significant increase in public debt limited the fiscal space for subsequent crises and worsened their impact. So, the solution to one crisis created a new systemic vulnerability that was tested and amplified by later events. And that naturally brings us to the Eurozone sovereign debt crisis, which unfolded from 2010 to 2015. For Europe, it was a prolonged economic challenge. This crisis stemmed from a balance of payments crisis, characterized by a sudden stop in the flow of foreign capital to countries dependent on external borrowing. The situation was further exacerbated by the inability of member states to devalue their currencies within the monetary union, which is otherwise a key tool for restoring competitiveness during external shocks. A critical factor was the lack of coordination of fiscal policy and the centralization of financial regulation among Eurozone members, which encouraged risky lending behavior. The crisis was triggered by the revelation of underestimated levels of public debt and deficit in Greece in 2009, which really means that Greece used less than clean and transparent methods when it came to reporting numbers and statistics. This was only revealed by a new government in Greece. Subsequently, there was a massive loss of financial market confidence in the creditworthiness of several other member states. The socioeconomic consequences within the EU were extensive. The crisis led to widespread austerity measures and a significant increase in unemployment rates, which reached as high as 27% in Greece and Spain. This led to an increase in poverty and income inequality. The impact on labor markets was severe and long-lasting. Eurozone employment remained about 4% below pre-crisis levels, and 5.5 million people lost their jobs. The unemployment rate peaked at 12.0% in early 2013. Investments across the EU fell by about 20%, with some of the most affected countries reporting losses exceeding 40%. The Eurozone even experienced a double-dip recession. The impact on global trade and economic stability was noticeable. The Eurozone crisis significantly damaged global economic growth, reducing the average annual growth rate by 0.65% from 2010 to 2012 and increasing the global unemployment rate by 1.81%. Global trade experienced a depression, with the average annual growth of trade decreasing by 1.14%. The import and export trade of the United States and China was seriously affected. China's economy saw a drop in the average annual growth rate of 0.37 percentage points, which, by the way, was a more severe impact than in the United States. This Eurozone crisis was not just a consequence of the global financial crisis, but rather a separate, internally generated crisis that revealed fundamental design flaws in the monetary union. It created a persistent competitiveness deficit for the EU versus the US, manifested in lower productivity, reduced trade dynamics, and a less flexible capital market, thereby solidifying the narrative of a constant crisis in the EU. An interesting point for you might be that when the ECB gave negative rates for the accounts to which the ECB sent money to banks as part of quantitative easing, or in other words, the famous printing of money to provide liquidity and money circulation and subsequent investments, the banks left that money in the accounts and preferred to pay these negative rates. The ECB was even forced to go further and also provide longer-term loans at negative rates if the bank was able to get them into the economy as much as possible. The Fed in the US didn't have to go that far because capital markets took care of liquidity and investments. When investors demand some kind of appreciation, they have to go into more risky assets, like stocks, for example, and there is no safer stock market than the most liquid one in the world, the American one. Banks in the US and EU behaved the same way. They didn't take on risk and didn't give or pass on liquidity into circulation or investments. So the ECB had to go and invent unconventional ways. The Fed never had to do that in its existence. It never had negative rates on deposit accounts. The difference is that the Fed doesn't have to, because the capital market in the US takes care of it. And that's the reason why the US has always gotten out of every crisis faster and with more growth than the European Union. That's also why, when a new crisis comes, the US has much more room to maneuver thanks to its capital markets. In the EU, discussions are being repeated about how to actually get money into the economy effectively. What do you think about that? Should a central bank have the power to intervene so significantly in the economy? And what do you think about unconventional tools like quantitative easing? Is it just a temporary solution or a necessity of modern times? Are you closer to a particular school of economics, such as the Austrian, Keynesian, or monetarist school? Or do you look at it more practically, without a specific direction? And what about the gold standard? Was its abolition a mistake? And how do you think it relates to the rise of cryptocurrencies? Write me your opinion in the comments. I'd be happy to read them. If this content interests you, I'd be grateful for a like or a subscription. Now, back to the story. And no sooner had we recovered from one crisis than another, completely different one, arrived in 2020, the COVID-19 pandemic. Unlike recessions caused by financial or macroeconomic imbalances, this one stemmed from a global health crisis that literally halted economic activities around the world. It was a sudden and profound shock to both supply and demand. the impacts on global GDP and trade volume were significant. World Gross Domestic Product, or GDP, shrank by 3.3% in 2020, a 5.8 percentage point drop from pre-pandemic forecasts. This meant approximately $7.4 trillion in direct economic losses for that year alone. The IMF predicted that the total cost of the pandemic to the global economy would reach an astronomical $12.5 trillion by 2024. Global trade was expected to fall by 9.2% annually. Governments and businesses took on massive debt during the crisis, raising concerns about future growth and debt sustainability. As a result of the decline in the global economy, the number of people living in extreme poverty worldwide increased by about 100 million to 110 million. The pandemic also led to an increase in nationalist and protectionist policies around the world, with up to 80 countries introducing bans or restrictions on exports, especially of medical supplies and food. It intensified the geo-economic rivalry between the United States and China, accelerating existing trends toward economic decoupling. It's interesting that, unlike the US and China, the EU remained largely committed to multilateralism. And even despite the global downturn, trade between the EU and China did not fall in 2020. In fact, total trade between the EU and China reached $709 billion in 2020, surpassing trade between the EU and the US, which was $671 billion. The COVID-19 pandemic acted as a catalyst for already existing geopolitical and protectionist trends. It accelerated the shift toward more regionalized supply chains and intensified geoeconomic competition. And the massive increase in global debt that occurred during the pandemic was added to the already high levels of debt from the global financial crisis. This significantly limited future fiscal space and deepened inflationary pressures, making the global economy more vulnerable to subsequent shocks. However, we need to realize that not every barrier in global trade is bad or discriminatory. The increase in nationalist policies during the pandemic serves as a prime example of this. Non-tariff barriers often arise as a result of different approaches to consumer, environmental, or public health protection. In the EU, laws are often stricter, for example regarding GMOs, hormone therapy, food safety, and environmental limits, than in the US or Asia. However, in WTO statistics, all deviations from the free movement of goods are recorded as barriers. Here are some examples of normal barriers. If a country were to legalize all drugs and wanted to export them, other countries, regardless of the WTO, would simply ban the import in accordance with their domestic law. The WTO would recognize this as a legitimate barrier if the reason is public health, not discrimination against the exporter. Different legal philosophies are more the basis of what I mean. In the EU, the approach is often cautious. If we don't know that a product is safe, we'd rather ban it. In the US, the principle is more, everything is permitted unless someone explicitly prohibits it or a risk is proven. That's exactly why some GMOs or hormone-treated beef are banned in the EU while they are legal in the US. In the statistics, this is recorded as a, quote, trade barrier. From a historical perspective, things that we protect by law today were not once considered a problem. For example, tobacco companies produced and funded studies that claimed cigarettes were harmless or even healthy and trendy. Their advertisements featured doctors recommending them, which led many in the public to believe these claims. As a result, people smoked everywhere, in offices and other indoor spaces. We need to realize that not every barrier in global trade is necessarily a bad or discriminatory thing. Legitimate protection of health, the environment, or moral standards plays a crucial role in global trade. While the WTO tries to delineate between legitimate regulation and hidden protectionism, the reality of political conflicts shows that this line is often not completely objective. And the next shock came in February 2022, the Russian invasion of Ukraine. This war had far-reaching consequences for the world economy and worsened already existing adverse global economic trends. We're talking about rising inflation, extreme poverty, and food insecurity. The EU's economic recovery after the pandemic was slower than expected, leading to a serious energy crisis and extremely high inflation in 2022. The conflict disrupted international trade and highlighted the EU's dependence on strategic goods and critical raw materials. The war fundamentally changed global energy markets. Russia was a huge supplier of fossil fuels, especially to Europe. In 2021, it supplied 40% of the EU's gas consumption and about 29% of the EU's total crude oil imports. The subsequent sanctions on Russian energy exports and Russia's weaponization of gas supplies led to a significant increase in global energy prices. In an effort to reduce its dependence, the European Union drastically limited imports of Russian energy. Gas imports, not consumption but just imports, fell from 45% in 2021 to 19% in 2024. And crude oil imports, due to the oil embargo, plunged from the aforementioned 29% in the first quarter of 2021 to just 2% in the first quarter of 2025. All imports of Russian coal were also banned. The EU committed to ending its dependence on Russian crude oil, natural gas, and coal by 2027 or 2030 through initiatives like the REPower EU plan. The consequences for economic and trade relations among the US, EU, and China were significant. The war increased geopolitical tensions and accelerated the risks of deglobalization. Trade between Europe and Russia has fallen sharply. China, on the other hand, played a central role in sustaining Russia's defense industry through massive exports of dual-use goods and critical components. The U.S. has pressured countries like China, India, and Brazil over their purchases of cheap Russian crude oil. An IMF analysis suggests that the world's division into blocs centered around the U.S. and China could lead to a 2% decline in long-term global output. This war forced a rapid and costly reorientation of European energy strategy. Before 2022, the EU relied on cheap Russian gas. After the annexation of Crimea in 2014, the EU's response to energy diversification was perceived as weak, naive, and ineffective. The decision to proceed with the Nord Stream 2 gas pipeline despite the 2014 invasion is an example of this. When Russia used energy supplies as a weapon in 2022, the EU was forced to drastically reduce its dependence. This rapid shift, driven by geopolitical necessity rather than just economic efficiency, represents a profound and lasting change in the European energy landscape. And while it strengthens geopolitical resilience, it brings new dependencies and short to medium-term economic costs that affect the EU's industrial competitiveness and contribute to inflationary pressures. And now we get to the core question. How exactly did the economic trajectories of the United States and the European Union differ after 2008, and why? The U.S. has shown greater dynamism and flexibility compared to Europe. Market valuations of U.S.-listed companies have more than tripled since 2005, while they've only grown by 60% in Europe. The productivity of American tech firms has grown by almost 40% since 2005, while that of European companies has changed little. This is supported by significantly greater innovation efforts, with U.S. research and development spending as a share of sales being more than double that of Europe. The U.S. shows stronger business dynamism, with fast-growing young companies employing 6 times more people than their European counterparts. The U.S. capital market is significantly deeper and more flexible, especially in the area of venture capital, which is about 4 times larger as a share of the economy compared to the EU. American firms have also issued twice as much equity relative to their size, which is key for financing intangible investments. On the other hand, per capita income in Europe is on average 1/3 lower than in the United States, primarily due to lower productivity. This weaker productivity growth stems from lower productivity in ICT-intensive sectors, a lack of investment in ICT, and an inability to capture the efficiency benefits of ICT. Despite its size, the EU market remains highly fragmented, with the intensity of trade between EU countries less than half the level between US states. This fragmentation hinders economies of scale and network effects. Europe has a surplus of small, low-growth firms and too few startups that grow quickly. Structural barriers in labor and product markets, including rigidities, have hindered economic recovery. The downturn in the Eurozone after 2008 was substantially longer than the recovery in the US, with real GDP per capita remaining below pre-crisis levels. The persistent economic divergence between the EU and the US after 2008 is fundamentally driven by the EU's inherent structural rigidities, a fragmented single market, underdeveloped capital markets, and lower investment in innovation. The EU's reliance on traditional bank financing instead of equity, coupled with its fragmented regulatory environment, creates a systemic innovation deficit that prevents it from fully harnessing the potential of new technologies. Let's look at GDP in current dollars. In 2008, the EU's GDP, which was 16.365 trillion US dollars, was approximately 110% of the US's GDP of $14.77 trillion. But look at this change. By 2023, the EU's GDP had fallen to $18.603 trillion, which is only about 67% of the US's GDP, which reached $27.72 trillion. From 2008 to 2023, the EU's GDP grew by only 13.5%, while the US's GDP grew by a significantly higher 87%. The EU's GDP per capita, as a percentage of US GDP per capita, fell from 76.5% in 2008 to 50% in 2023. Although the nominal divergence is significant, it's important to note that using GDP in current dollars can be misleading due to exchange rate fluctuations. When measured by purchasing power parity, or PPP, the EU27 and the US had roughly the same output in 2000, and by 2022, the EU27's economy was only 4% smaller. The IMF predicts that this gap will widen slightly to 6% by 2028. Leading economic institutions are showing us the way forward. Their recommendations are clear. We need to deepen the EU's single market. Removing remaining barriers and advancing the capital markets union would stimulate investment in research and development. We need to strengthen the EU's capital markets. Increasing the availability of equity, especially venture capital, is key to financing innovative startups. We must invest in innovation and digital infrastructure. Focusing on increasing research and development spending and improving digital infrastructure is essential to boosting productivity. We should continue energy diversification and the green transition. While the transition is costly, investments in renewables are key to long-term energy security. We need to address structural rigidities. Labor and product market reforms that reduce administrative hurdles and increase flexibility are essential. We should strengthen strategic autonomy with openness. The EU should continue to pursue open strategic autonomy, which reduces critical dependencies while maintaining openness for cooperation. The global economy is moving toward a more fragmented and less predictable order, where geopolitical considerations are increasingly influencing trade, investment, and energy policies. For the EU, it's crucial to address its structural weaknesses and strengthen its resilience to prosper in this new environment. We've been reminded that fragmentation in the world is growing. Europe has been in a constant crisis for almost 20 years, similar to the Weimar Republic, and now comes the year 2025, a year when the world has seen that general knowledge in America is not at its best, and it talks about the need for better education, especially with the elections in mind. If people believe that countries pay tariffs, then something is really wrong. And if a country whose decisions affect the economic fate and security of the rest of the world is also losing basic economic insight, all that remains is to hope that at least the EU will finally learn from its own history, with the Weimar Republic. In this economic drama, economies are interconnected. What happens in one affects the others. We'll start in the United States. At the beginning of the year, it looked like a minor economic retreat. In the first quarter of 2025, U.S. GDP fell by 0.5%. Many might have expected a boring year, but the opposite was true. The second quarter brought a sharp turnaround. Real GDP jumped by 3%, a number that grabbed the attention of journalists and analysts. But under the surface, it's a bit more complicated. Behind this headline news was a sharp drop in imports into the country, which alone managed to boost GDP growth by more than 5 percentage points. In other words, when Americans buy less from abroad, GDP on paper rises. And while the economy seems to be strengthening, it's not that simple in reality. Consumer spending in the country went up, which was positive. People were spending more on services like healthcare, restaurants, and financial advice, as well as on goods like cars and medicines. But when we look at business investment, there was a major break. Private investment fell by 15.6% year-on-year, the sharpest drop since the pandemic, and corporate inventories began to run down quickly. When we separate the noise from all these numbers, that is, we exclude volatile items like trade, inventories, and government spending, we find that core growth in the second quarter was only 1.2%. Essentially, on paper, the U.S. grew, but its muscles are still weakened, and the question is how long this recovery will last. Now we move to Europe, where the story is even more subtle. Here there's no roller coaster ride, but rather a slow climb uphill. In the Eurozone, GDP grew by only 0.1% in the second quarter, and in the entire European Union by 0.2%. Both numbers are significantly weaker than the growth at the beginning of the year, when the Eurozone was still growing by 0.6%. Year-on-year, growth in the Eurozone was just over 1%, specifically 1.4%, and in the EU, 1.5%. But when we break down the individual countries, we see some big differences. Spain jumped by 0.7%, Portugal by 0.6%, but Ireland fell by a full percent, and Germany and Italy also ended in the red. What does this mean? Growth in the EU is uneven and extremely fragile. Some economies are visibly accelerating, while others are reversing, which means that joint decision-making is more complicated, and the entire union is more susceptible to external shocks, such as trade disputes or changes in global supplies. Major economies like Germany, which usually set the pace, are now stagnating, and if the situation doesn't improve, we can expect a greater divergence in performance among the union's countries. And now for China, the fastest runner on this economic track in 2025. The country's GDP grew at an average rate of 5.3% in the first half of the year. Specifically, it was 5.4% in the first quarter and 5.2% in the second, which is still impressive momentum. China's industrial production grew by as much as 6.8% in the first half of the year, which helped keep overall economic performance high. But under the surface of the story, there are also serious weaknesses. Domestic demand remains weak, and in June, retail sales grew at a slower pace, by only 4.8%. Much more striking is the collapse in real estate investment, which fell by as much as 11.2% in the first half of the year. The Chinese economy is also facing deflationary pressures. Consumer prices in April fell by 0.1% year-on-year for the third consecutive month, and the producer price index even fell by 2.7%. In practice, this means that demand for both goods and services is weakening, and growth is increasingly dependent on government support and exports. In conclusion of this economic story, it's clear that all these characters are interconnected. When imports fall in the US, it affects manufacturers from other countries. When one of the major economies in Europe stagnates, it also affects global trade. And when China exports cheaper goods due to deflation, it can hit competitors around the world. All these small movements and numbers together create one big, dynamic story that is unfolding in 2025, with constant tension, but also with many opportunities. And now that we know the current picture of the American, European, and Chinese economies, let's look at how these trends are perceived and interpreted by top global analytical firms. Here, it's interesting to note the difference between the views of an investment bank like Morgan Stanley and consulting giants like EY and PwC. Their job isn't to directly manage bank portfolios, but to advise their clients, who are often large corporations, investors, or governments, based on deep analysis and global data. Morgan Stanley, as an investment firm, typically highlights key market and investment risks. This year, it's talking about a widespread slowdown of the global economy, which will be mainly driven by the shock of new American tariffs. It warns of an inevitable increase in market volatility and anticipates that the European Central Bank may have to cut rates in 2025 even faster than the U.S. Federal Reserve. Their emphasis is on the fact that high tariffs increase inflation, which makes goods more expensive and pushes commodity prices up. EY and PwC, as global consulting and auditing firms, focus mainly on longer-term trends and recommendations for corporate strategy and effective value protection. EY predicts that while global GDP will still grow slightly in 2025, this growth will be highly unsynchronized, with regional differences deepening. According to EY, the U.S. will remain a leader, but one that also has the potential to stir up and disrupt global markets, especially if its trade policy leads to higher tariffs. EY warns that if tariff measures spread, the entire world could find itself on the brink of stagflation, that is, stagnation with high inflation. PwC views the markets with some optimism, pointing in particular to the revival of the IPO market, where firms with strong fundamentals and compelling stories are attracting investors. However, it emphasizes that the outlook for the rest of the year is uncertain. The dominance of extremely high-growth sectors, mainly AI and machine learning, is causing capital to be concentrated in a narrow group of companies and sectors, while other areas may suffer from underinvestment. PwC therefore recommends capital protection through selectivity. discipline, and a focus on real quality, especially in uncertain times. From the perspective of an investor or a manager, this means that universal, broad investment strategies are no longer sufficient today. It's much more important to identify the strongest players, whether in the IPO market, in AI, or in sectors resilient to global shocks. The world is simply moving towards a reality where careful selection, diversification, and a quality strategy are the foundation of capital protection, even in the turbulent environment of 2025. I'm not a big fan of relying on simple macroeconomic data without a deeper analysis, especially for people who don't fully understand what it reflects or the potential errors in its methodology. For example, GDP is a summary of all activities in an economy. In principle, it doesn't tell us if a country is richer. It's just an indicator of economic activity, not profitability. Likewise, inflation doesn't necessarily give you a direct picture of what's truly happening with prices in a given economy. It's an endpoint statistical index. And GDP per capita doesn't show how much people in an economy are actually earning. It's just an index that talks about economic activity per person. To put it more precisely, imagine you wake up and check if you're breathing and have arms and legs, and if you're not sick. Inflation, on the other hand, is like looking at your bank account and seeing how much you spent last month versus this month. However, a statistical index assumes you buy every single product and service in the entire economy every month. So when you say that buying 12 cars a year is stupid, you begin to understand the limitations of a statistical index. Furthermore, when you look at something like purchasing power parity, PPP, it's also nothing more than a statistic. It works well if you compare yourself to a friend who lives a very similar life. But as soon as someone else comes along who doesn't buy a single shirt but has 50 because their children make them, and the PPP basket is focused on shirts, you're at a disadvantage. In this way, we remain logically connected in our economic story from a macro view to other data, but those are also just indexes. It's like you want to create a benchmark for 1 million companies. You have to find things to start with, but it's not a complete analysis of 1 million companies. Let's start in the United States, where in June 2025, producer prices, that is, what businesses pay when they buy goods and services, remained unchanged at first glance. But the depth is hidden under the surface. Prices for goods rose slightly by 0.3%, while services became cheaper by 0.1%. Year on year, the PPI, or Producer Price Index for Final Demand, rose by 2.3%. In food, we see really sharp differences. Prices for fruit and melons rose by 3.1%, but vegetables became cheaper by 1.7%. Meat and processed poultry became more expensive by over 1%, while eggs became cheaper by as much as 7.4%, and dairy products also fell slightly by 0.3%. Such price jumps in practice are immediately reflected in the hospitality business, where it's not possible to stock up for months in advance. Every restaurateur or chef knows this. If eggs drop by 7%, breakfast becomes cheaper immediately. However, if meat or poultry jumps higher, the menu can change literally overnight. This means lower margins for businesses or, conversely, higher prices for guests. In the European Union, the movements in agricultural prices at the beginning of the year were even more pronounced. Average prices for agricultural products rose by 2.6%, but milk prices climbed by 12.6%, eggs by 10.7%, and cereals by 9.6%. Conversely, olive oil fell by as much as 43.5%, and potatoes by 13.4%. Industrial producer prices in the Eurozone fell by 2.2% overall in April 2025, mainly due to a drop in energy prices of almost 8%. Even though these numbers indicate pressure on European farmers and producers, from the perspective of end customers, tourism and interest in travel paradoxically did not fall. On the contrary, tourism in the U.S. is expected to grow by 13% in 2025, with New York expecting more than 68 million visitors. In California, however, a decline in foreign tourists of 9.2% is also expected. In Florida, Canadian visits by car fell by as much as 38%, and by air by 24%, which directly affects the regional economy. Las Vegas saw a decrease in visitors of 6.5%, and hotel rates on the famous Strip Street itself fell by 5.5%. The impact on businesses and employment for states like Southern Nevada, with 29.3% of the workforce in the leisure and hospitality sector, Atlantic City, where 23.3% of GDP comes from leisure and hospitality, and Orlando, with 18.9% of the workforce in the leisure and hospitality sector, are highly dependent on tourism. The decline in international tourism, especially from Canada, has a direct negative impact on tourism revenues and can lead to job losses in these regions. For example, Hawaii could even fall into a recession at the end of 2025 due to a decline in tourism. In Europe, international tourist arrivals in the second quarter of 2025 rose by 3.3%, with spending in Spain increasing by 7.2 billion euros in the first quarter alone. More and more travelers are being motivated by the desire for better value for money and are choosing less well-known destinations, which helps to ease the pressure on overcrowded tourist centers. The numbers thus reveal not only the rhythm of the global economy, but also its internal tensions and rapid changes that people and businesses will feel in their wallets and in their daily decisions. From the prices of fruit to summer holidays or business success in a hotel, that's the dynamic of inflation and prices in 2025. Behind every story, there is literally a real number. We're seamlessly moving on to another important chapter of real life and macroeconomics. Household debt and delinquency, that is, late payments. These numbers are an unusually sensitive barometer of the real health of the economy because they transmit all risks, from food prices to the policies of central banks. In the United States, the total household debt continues to grow. In the first quarter of 2025, it increased by $167 billion, which is a quarter-on-quarter increase of 0.9% to a record total of $18.2 trillion. It's interesting that under the surface, we see contradictory trends. Credit card balances fell by $29 billion, and auto loans fell by $13 billion, which is only the second decline in this category since 2011. Housing mortgages, however, continued to grow, with home equity lines of credit rising for the 12th consecutive quarter. Student loans increased by another $16 billion to a total of $1.63 trillion. However, the real key change was brought by delinquency. 4.3% of unpaid household debt in the U.S. is already in some stage of problematic repayment. Serious delinquency, that is, 90 or more days late, remained stable for credit cards and auto loans, but in the case of student loans, there was a sharp jump. As many as 7.74% of all student loans were more than 90 days past due in the first quarter of 2025, although it was less than 1% at the end of last year. This increase is largely a statistical effect. After a period of moratorium, the reporting of delays to credit authorities was resumed. Nevertheless, it is a signal that a large part of the population that hasn't dealt with repayment for years is again exposed to tough rules, and the pressure on their wallets is intensifying. It's particularly alarming that the increase in problematic credit card repayment, with as many as 12.3% of them 90-plus days past due, the most since 2011, affects not only lower-income households but also the better off, with annual incomes above $150,000. This is a pressure that could influence people's willingness to spend and overall economic growth in the coming months. On the other side of the Atlantic, the story is, at least for now, more positive. In the Eurozone, the ratio of household debt to income fell to 81.7%, which is more than 2 percentage points lower than a year ago. The debt-to-GDP ratio also fell to 51.2%. However, the Eurozone's total net savings have decreased to just under 800 billion euros over the last year, signaling that European households have had to dig deeper into their reserves. Banks in the Eurozone have already started to slightly tighten credit standards in the second quarter of 2025, especially for housing and consumer loans. As many as 11% of bankers are reporting a tightening of conditions, which means that many applicants, especially risky ones, won't get money so easily anymore. Demand for consumer loans remains stable thanks to falling interest rates, but is dampened by lower consumer confidence and savings being mostly at a minimum. Therefore, even though the quality of households' credit portfolios is stable for now, regulators remain on alert. In an environment of rising living costs and specific sectoral shocks, the first negative signals can grow quickly. Overall, we see that household debt, the ability to repay, and the willingness of banks to lend are becoming one of the most sensitive indicators in 2025 of how economic cycles and global shocks are reshaping the daily lives of millions of families on both sides of the ocean. In the next chapters, we get to the pulse of the real economy, investments, small business loans, and changing consumer habits on both sides of the Atlantic. In the United States, the market for small business loans is in flux. According to a survey, as many as 88% of American small businesses face regular cash flow gaps. Although more than 90% of them believe in growth this year, only a third systematically optimize their finances. As many as a third admit they wouldn't be prepared for an economic shock. What are the main external pressures? Inflation and uncertainty in trade policy are exactly the factors that have been affecting households for months. Despite higher demand for operating loans, bank standards remain strict, although the expected onset of loosening is on the horizon, mainly thanks to regulatory reforms and competition from new fintechs. SBA loans, often key for small firms, are expected to grow by 10% to 12% in 2025 and reach at least $55 billion. This means that businesses are most often borrowing not for expansion, but for daily survival and operations. New orders for American durable goods fell by 9.3% in June 2025, mainly due to weaker demand for transportation. If we subtract transportation, other orders grew slightly by 0.2%. However, consumers are clearly prioritizing essential goods and services, while postponing large purchases like cars and expensive appliances. In the second quarter, spending on services and non-durable goods grew the most. In the European Union, banks in the second quarter left credit conditions for small and medium-sized enterprises mostly unchanged, while conditions for large businesses were slightly relaxed. However, this doesn't mean easy access to loans. Banks tightened standards mainly due to an increased perception of risk in a volatile environment. Consumer demand is still cautious and prefers ordinary consumption over expensive investments. Overall, in the first quarter, household spending on consumption in the EU grew by 0.2% nominally, but in real terms, it fell by 0.2% in the Eurozone and by 0.3% in the EU. It shows that inflation and wage stagnation are reducing purchasing power. New car registrations in the EU in the first half of 2025 fell by 1.9%. Battery-powered electric vehicles grew, but traditional gasoline and diesel cars declined sharply. Similarly, manufacturers of home appliances still recorded a 5.2% decline in production in the fourth quarter of 2024, and production is only beginning to recover very cautiously. The common denominator is caution. Firms are borrowing mainly to survive, not to grow. Consumers are saving and postponing large purchases. Banks remain cautious, and the market in both regions shows early signs of fatigue from a period of uncertainty. Consumer confidence, willingness to invest, and the availability of credit are even more volatile today than they once were. We are buying more of what we really need, and we are calculating investments and repayments even more carefully than last year. We continue to expand the story and the pulse of the global economy, this time through the prism of transport and the international trade link between the U.S. and the European Union. It's logistics and the movement of goods that often prove to be the most sensitive barometer of global trends, tensions, and new opportunities. In the first half of 2025, global trade in goods and services remained strong and expanded year-on-year by an estimated $300 billion. This means that despite frequent reports of uncertainty, firms on both sides of the Atlantic were able to deliver more, thanks to a 14% increase in U.S. imports and a 6% increase in EU exports. However, total trade volumes grew by only 1%, which reveals that the growth in values was also driven by a slight increase in the price of traded goods. Air cargo remains a fast link between continents. In the first quarter, global demand for air cargo rose by 3%, which was significantly less than the extraordinary 11% in the same period a year earlier, but still meant movement forward. Air freight rates rose by 4%, but momentum slowed considerably in June, with volumes increasing by only 0.8%. On the transatlantic corridor between North America and Europe, which is the second busiest in the world, we still see growth of 4.8% year-on-year. This means that the most important trade arteries remain pulsating, even as overall air freight growth slows. However, maritime transport came under pressure. In May 2025, the U.S. deficit in trade in goods and services rose to $71.5 billion, with the U.S. deficit, with the EU reaching $22.5 billion. Overall, the deficit deepened by half, or 50.4%, compared to 2024. Forecasts for shipping demand were revised downwards, mainly due to the effects of tariffs and political uncertainty. At the same time, the growing supply of shipping capacity, with new ships entering service, is putting pressure on rates and profitability in the sector. As for road transport in the EU, rates fell during the first quarter of 2025, and the growth of free transport capacity continued, with vehicles and drivers often not having full utilization. EU exports grew by 8.6% and imports by 4.1%, mainly thanks to stronger trade with the US. However, internal trade within the EU grew only very slightly, which means that pressure for a further drop in rates persists. In summary, 2025 confirms that even though global logistics are still firmly underway and the volume of goods is growing, a struggle of prices, capacities, and uncertainty is taking place within this growth. The busiest transatlantic lines between North America and Europe may be keeping trade afloat, but firms and carriers are working more rationally and reacting quickly to every fluctuation in demand or costs. Even though we have so far focused mainly on big numbers and trends, other specific data can show us a different story, but they may not reflect the overall microeconomic level or reveal the fundamental truth. In the cinema business, the global industry saw an optimistic revision. Revenues in 2025 are expected to reach as much as $34.1 billion, which represents a year-on-year increase of 13%. However, this growth is mainly driven by global markets outside the U.S., as the forecast for the domestic American market went down slightly, from $9.7 to $9.5 billion. This reflection of reality is also underlined by the fact that there were fewer blockbusters in the first quarter than producers expected. But even in a weaker period, some players can grow, like Cinemark, which reported revenues for the first half of the year that were 13% higher than last year, at $1.5 billion. The concert industry is experiencing a period of contrasts. Globally, it expects record revenues thanks to stadium tours in North America, Europe, and Latin America. The gross revenues of the top 100 tours were $2.81 billion in the first half of the year, which is 8.4% less than last year. At the same time, the average revenue from a single event is increasing. A performance today brings in an average of $1.7 million, a quarter more than the year before, while the average attendance at a concert grew by as much as a third to more than 14,000 spectators. This is the result of a larger number of huge stadium events, although the average ticket price paradoxically fell by 5.5%. A key signal of the contradiction between macro-robustness and micro-tension is the boom in BNPL services, or Buy Now, Pay Later. In the U.S., almost half of respondents already use these services, and as many as a quarter are using them to buy groceries, up from just 14% a year ago. Late payments have also increased significantly. 41% of BNPL users admit to having problems with repayment, which is an increase of 7 percentage points in 1 year. As many as 58% of users say that BNPL has enabled them to buy only what they otherwise could not afford. Europe is not far behind. The BNPL market is expected to grow by more than 12% in 2025 to almost $200 billion, driven mainly by an explosion in online purchases and the need for flexible credit. The entertainment industry is growing, but often thanks to larger events and lower ticket prices. Ordinary consumers are responding creatively to rising prices and limited budgets. For example, with installment payments like BNPL, which not only brings higher availability, but also a growing risk of debt. It is these quiet signals, sometimes against the current of macro numbers, that point to the fragility of real budgets and the real decision-making dilemmas of millions of families and businesses in the US and Europe. The gig economy, often also referred to as the one-click economy, continues to grow rapidly in 2025. While it was worth $556.7 billion in 2024, it is expected to reach $646.8 billion this year, which means a year-on-year growth of over $90 billion. Forecasts say that by 2033, this sector will exceed a value of $2.1 trillion, with an average annual growth of around 16%. Behind this large figure are interesting changes in the behavior of both consumers and the supply of services itself. Platforms like Angie, which connect various craftsmen and professionals with domestic customers, saw a year-on-year decline in revenues of 19% in the first quarter of 2025. But the reason was not just weakening enthusiasm for online services. The main reason was strategic. The platform opted for the homeowner's choice and began to prioritize quality requests and filter out automatically assigned, often poor-quality, offers. As a result, while the total number of requests fell, professional providers saw higher success rates and growing loyalty. More than two-thirds of the requests on the Angie platform are for so-called non-discretionary services, which are things that people need quickly or simply cannot postpone, like emergencies, breakdowns, or necessary maintenance. Discretionary, or postponable, services now make up only a third of requests, and this is where consumer caution in a period of uncertainty is fully reflected. While large and expensive projects are being put on hold, smaller repairs and maintenance remain in demand. Overall, it shows that the growing volume of the gig economy is accompanied by careful selection and more responsible decision-making on the part of customers. Demand is growing, but consumers are placing a greater emphasis on verified professionals and the quality of services, especially when it comes to projects that cannot be postponed. This trend is also part of a broader shift in the US and EU economies towards rationalizing spending, strengthening values, and increasingly cautious management of the family budget. And what about you? Do you use such services? Do you only go by price because of the budget? Or do you simply not want to pay more for services through established companies? This question just shows that you can't simply believe, but always ask questions. A microeconomic view of transport in 2025 beautifully reveals how changes in the market, such as fuel prices, innovation, and savings, translate into people's daily habits. In the United States, oil production is expected to decline after reaching an all-time high in the second quarter. But from a consumer perspective, we already see that individual gasoline consumption in advanced economies like the US has been declining slightly for a long time. This is the result of two trends: technological progress, with more fuel-efficient or electric cars, and the growing use of public transport. In April 2025, the use of public transport in the U.S. recovered to 85% of pre-pandemic levels. Buses and on-demand transport are even closer to the old numbers, reaching 86% and 93% of 2019 levels. For many, it is becoming increasingly motivating to change the way they travel, especially if they can save over $13,000 a year by using public transport instead of a car. This shift is a direct response to rising input costs, more expensive cars, servicing, and the fuel itself. In the European Union, cars may still dominate the roads, but policies and infrastructure are increasingly directing people toward public, shared, and sustainable transport. The trend clearly shows that the higher the cost of mobility, the greater people's willingness to switch, whether to a train, bus, or bicycle. This entire movement is not only an ecological, but also a purely economic decision. People are recalculating their budgets, looking for savings, and adapting to an environment where every refuel or car service noticeably hits their wallet. The declining consumption of gasoline in OECD countries in 2025 is therefore not just the result of technological possibilities, but mainly proof that saving is becoming one of the strongest motivations of daily life. In the United States, as much as 80% of cut flowers are imported, mainly from countries like Ecuador, Colombia, and the Netherlands. When a tariff is imposed on these products, such as the proposed 25% on Dutch flowers, it has an immediate impact on the entire supply chain. American florists face higher costs, European exporters lose their advantage, and ultimately, the consumer pays more. In addition, with flowers, it doesn't work so that America could quickly replace expensive imports with domestic production, as the climatic and seasonal limitations are too great. So it happens that higher tariffs cause a noticeable increase in prices in flower shops across the U.S., often during key periods like Valentine's Day or Mother's Day. This specific example clearly illustrates how global economic decisions can directly and noticeably affect the daily budgets of households and the relationships between international partners, sometimes just in the form of a more expensive bouquet for a birthday. In 2025, the senior care sector is one of the areas where price growth is outpacing general inflation and revealing the real pressure on household budgets. In the United States, the costs of home and institutional care for seniors and the disabled are as much as 74% higher than in 2005, with average inflation in this segment reaching 2.8% per year over the last 2 decades. In the last year alone, inflation in Seniorcare exceeded 3.9%, while overall inflation was 2.5%. Services for senior citizens are thus becoming more expensive faster than the average for other goods and services in the economy. In the European Union, the trend and reasons are similar. In the first quarter of 2025, hourly labor costs in the Eurozone rose by 3.4%, and in the entire EU by 4.1%. It is this dramatic growth in labor costs and services that translates into an increase in prices for senior homes, personal caregivers, and home care. The result is that senior care is taking an increasingly larger part of family incomes. Since this is a service that is often necessary and cannot be easily postponed or replaced, households have to shift an increasingly larger part of their budget to these expenses. This automatically reduces their options to spend money on other goods and services. This trend is becoming a key microeconomic phenomenon not only in the US, but also increasingly in Europe, where the population is aging and the demand for these services continues to grow, which only strengthens the pressure on family budgets and public finances. Online marketplaces and consumer behavior in 2025 clearly reveal how changes in macro and microeconomics are translating into everyday practice, especially into how and on what people are willing to spend money on the internet. On the Etsy platform, we see a year-on-year decrease in gross merchandise sales, or GMS, of 4.8% in the second quarter of 2025 and a loss of active buyers of 4.6%. On the other hand, the company's revenues grew by 3.8%, mainly thanks to an increase in advertising and payment fees. Etsy is thus earning more on a smaller volume of sales. Although the volume of sales through mobile devices increased, the overall decline shows that consumers are saving even on smaller, unnecessary expenses, which are typical for Etsy, where unique, design, and handmade products prevail. The sale of the Reverb platform suggests a further narrowing of the focus to the main segments. A similar trend can be seen on Craigslist, still the most visited classifieds portal in the US. However, this position has been under pressure for 6 years. Revenues, which exceeded $660 million in 2021, fell to $302 million in 2024. The reason is growing competition, mainly from Facebook Marketplace, OfferUp, and Mercari, which offer faster or more convenient trading. Consumers are also changing the way they shop on discount and coupon portals. Although Groupon saw a 5% drop in its revenues in the first quarter of 2025, its billings, that is, the value of the deals billed, increased by 1%. In North America, local billings even accelerated to double-digit growth. This suggests that people are increasingly actively looking for discounts, great deals, and are maximizing the value of their spending, even at the cost of spending less in absolute terms. The resulting picture is that consumers are stricter with their own spending, prioritizing value and functionality over unnecessary luxury or originality. Online marketplaces, whether global or local, function as sensors of the mood in society. When the budget is under pressure, sales fall, interest in discounts grows, and people are more calculating about where and on what they spend every dollar. All this fits into the mosaic of behavior that is being shaped in 2025 by rising prices, uncertainty, and a growing emphasis on everyday value. Consumer behavior in the US and the EU in the first half of 2025 confirms that macroeconomic stability and positive aggregates don't always mean a real sense of well-being in people's wallets or a willingness to spend more. In the United States, consumer optimism in the first quarter remained almost as high as at the end of last year, helped by low unemployment and relatively stable inflation. Despite this, 3/4 of Americans admitted that they, quote, traded down, meaning they deliberately swapped more expensive brands for cheaper alternatives. This trend is widespread throughout society, but it is most pronounced among younger generations, Gen Z and millennials, who most often save either by choosing cheaper retailers or by directly limiting the quantity of their purchases. We see a similar picture in Europe. While consumer sentiment in the second quarter of 2025 remained stable, the intention to spend either stagnated or grew only slightly. Europeans more often declared that they would adjust their spending to increased prices by reducing the quantity or switching to cheaper stores. This shift toward seeking value is also confirmed by positive trends for discount and bargain brands. Microeconomic indicators only amplify these moods. A record share of BNPL service users are now using deferred payments for groceries. Sales on voluntary platforms like Etsy and Craigslist have fallen, and consumers are actively looking for good deals, discounts, and second-hand markets. All these signals show that family budgets are under pressure, and the willingness to spend on necessities is much greater than the risky desire for unnecessary things. In summary, although the macroeconomy may create the impression that 2025 is a friendly year for households, the reality in stores and the digital world is different. Many consumers are just adapting to rising costs, are forced to trade down, and are considering every purchase more carefully. This trend is especially strong among the younger generations, and it is an important signal for any company or business that wants to succeed in this new reality. What do you think? Am I right? The conclusion of the micro and macroeconomic analysis of the US and EU for the first half of 2025 shows a complex and often contradictory picture of the economy, where the headline numbers are far from capturing all the hidden tensions. In the United States, the headlines are deceptive. The headline GDP growth in the second quarter of 2025, at 3.0%, seems optimistic, but it was mainly driven by the statistical effects of sharply falling imports, not by the organic strength of the economy. Private investments fell significantly, core growth slowed, and while employment remained at a stable level of around 4.2%, the growth of new jobs slowed down. Household debt rose, with the biggest warning being the sharp increase in student loan delinquency, caused by the resumption of reporting on unpaid loans, as well as rising delinquency on credit cards. The effective tariff rate reached a record 18.3%, which makes imports more expensive and puts pressure on both GDP and employment. Inflation, however, remained relatively low, probably due to weakening demand and other offsetting factors, not because price pressures disappeared. In the European Union, GDP growth in the second quarter was positive, but slowed to 0.1 to 0.2%. Moreover, this growth is extremely uneven. Southern European countries grew, while the North and the core stagnated or weakened. Employment remained stable, but banks tightened their lending rules, which could stifle future consumption. While household debt indicators improved, we are finding warning signs, especially in the availability of credit and the growth of wage costs and services. The microeconomic data is even more unambiguous. American and European consumers are increasingly prioritizing value, turning to cheaper options, discount platforms, and are already using BNPL services for everyday items like groceries. Spending on expensive goods and investments is taking a back seat, which is evident from the falling orders for durable goods in the US and the weak registration numbers for new cars in the EU. Consumers are increasingly cautious. Even though sentiment remains relatively positive, behavioral data shows a trading down trend across generations. Deferred payments, growing dependence on discounts, and a drop in sales on platforms like Etsy and Craigslist show that the pressure on budgets is palpable, and households are responding with savings even on small items. In specific sectors such as senior homes and care services, costs are growing faster than inflation, which significantly burdens family budgets. Tourism, which is a barometer of resilience and mood, is growing globally with a 13% increase in spending in the US compared to 2024, but regional differences are large, and states dependent on international arrivals are facing a decline. In the EU, on the other hand, tourist arrivals are increasing, driven mainly by Chinese and American clientele, and there is a shift toward higher-value tourism. If we combine these signals, we get a picture where, beneath the surface of headline GDP, low unemployment, and stable inflation, the level of consumer financial stress is rising, and consumer courage and confidence in the future are decreasing. Despite the macroeconomic comfort, household budgets are becoming more and more stretched. Debt is growing, and the willingness to spend on anything other than necessities is weakening. The overall environment in 2025 is therefore fragile, and future developments will depend on how individual governments, companies, and households withstand the sum of changing pressures, from tariffs to inflation to changing values and consumer psychology, which is ultimately also related to employment and geopolitical pressures. According to a European Parliament report entitled U.S. Tariffs, Economic, Financial, and Monetary Repercussions, a tariff increase on China and the EU, and a reduction in exports from the EU to the US, could lead to a loss of 8,000 to 10,000 jobs in the EU, for every €1 billion loss in exports. At the same time, in some sectors and with reduced investments, the losses could be as many as 12,000 to 15,000 jobs in the EU, according to historical multipliers from an analysis by Battazzi et al. From 2025. This leads us to another significant event in 2025. Summer 2025. A massive trade war looms on the horizon. The United States is threatening 30% tariffs on European goods, and Europe is preparing countermeasures. It is in this atmosphere that one of the key moments takes place on the international stage, the so-called framework agreement between the European Union and the United States. President Trump and European Commission President von der Leyen announced it in Scotland just a few days before the tariff D-Day. On paper, everything sounds ambitious. The goal is to immediately de-escalate trade tensions and set new rules for the world's biggest market players. The agreement introduces a single 15% cap on American tariffs for most EU goods, instead of the threatened 30%. According to the communication, this is intended to immediately relieve the most sensitive sectors, especially the automotive industry, where the tariff rate is reduced from the original 27.5%. At the same time, the EU is removing its already low tariffs on American industrial goods and opening up some agricultural sectors. The EU has committed to a giant goal, to purchase $750 billion worth of LNG, crude oil, and nuclear fuel from the US in the next 3 years. The motivation is to gradually cut off from Russian sources and diversify. The goal is also to increase European investments in the US by another $600 billion, declared as strengthening economic ties. Unclear but with great emphasis, European countries are to buy hundreds of billions of dollars of military equipment from the US. The agreement also promises cooperation in security, the resilience of supply chains, and the fight against non-market policies. At first hearing, it sounds like a huge breakthrough, but experts emphasize that it is not a legally binding treaty, but rather a, quote, political framework, or an agreement on principles. European Commission President von der Leyen herself reminds us that the details will only be ironed out in the coming weeks, and economic analysts immediately add that promises of energy purchases and investments are not legally enforceable, and in practice depend on commercial players and future political decisions. The advantage of this approach is political flexibility. It's possible to immediately celebrate a victory, de-escalate tensions, and buy time for further negotiations. The downside, however, remains uncertainty. What of the numerical targets will be really met, who will really benefit from it, and whether the framework agreement will turn into a sustainable relief of trade relations. The level of political commitment is high. The highest leaders, Donald Trump and Ursula von der Leyen, are signing it in front of the world's media, just a few days before the new tariffs are due to come into force. The White House is preparing a fact sheet, and the European Commission is also preparing one, and joint statements and press conferences underline the intense pressure for quick negotiations. Alongside this main stage, however, lower-level technical agreements on research and data sharing are also taking place, showing that the framework is politically explosive, but the details must also be handled by experts and officials. When EU and US leaders presented the framework agreement in July 2025, the world saw headlines about stabilizing relations and record values, or criticism of the agreement, and the European Commission and its representative. What is hidden behind the numbers, and what is their real meaning? American tariff cap on European goods are 15% on most EU goods heading to the US. For car manufacturers, this is a relief in that the originally planned 27.5% was averted, but it is still a sharp increase compared to the past, as the average rate was only 1.2% in 2024. This step is expected to have the greatest impact on European export factories in Germany, Italy, and France. EU tariffs on American goods deal says almost all tariff barriers on American industrial imports into the EU will disappear, with tariffs going practically to zero, and access for certain American agricultural and fishing products is improved. Energy and investments, in sense of the political promises, are huge. Europe promises to buy $750 billion worth of LNG, crude oil, and nuclear fuel from the US over 3 years. The EU also plans $600 billion in investments in the US. There is also a commitment from European countries to buy hundreds of billions of dollars of military equipment from the US. Warning, these sums sound groundbreaking on paper, but all experts agree that they are more political signals than enforceable and realistically achievable goals. In practice, most will depend on future market conditions, the private sector, and subsequent specific negotiations. The main element of the agreement is its asymmetry. While most EU goods for the US will now be subject to a 15% tariff, American goods heading to the EU will be practically exempt from tariffs. The trade war has thus become a unilateral retreat by Europe, which preferred to accept unfavorable conditions rather than risk even greater destruction of trade relations. For the EU, the increase in the average tariff on exports to the US from 1.2% in 2024 to 17.5% is dramatic. Analysts estimate a 0.2% drop in EU GDP, and according to scope ratings, Germany and Italy could lose as much as 0.4 percentage points of production this year alone. Impact on sectors for car manufacturers like Volkswagen, BMW, and Mercedes, who suffer the most. Volkswagen already reported a 29% drop in operating profit in the second quarter of 2025, with tariffs costing it €1.3 billion in half a year alone. Similar pressures are on the steel, pharmaceutical, and wine producers. Conversely, the U.S. gains not only duty-free entry for its goods and cars, as even American cars will have only a 2.5% tariff in the EU instead of 10%, but also a better chance to sell energy, military equipment, and other goods to the Euro market. Conclusion for you: the agreement averted an immediate catastrophe, but at the same time created new, longer-term risks for Europe's competitiveness. In the words of economists, it's short-term peace at the cost of a weakened position in the market. The numerical targets, although politically useful for press releases, will in reality depend mainly on the business decisions of specific companies, market prices, and developments in the coming years. One of the most highlighted points of the EU-US Framework Agreement from July 2025 is the promise to dismantle so-called non-tariff barriers, or NTBs. These are often a greater obstacle to international trade than tariffs themselves, especially when it comes to complex regulatory hurdles, such as technical standards, customs procedures, country of origin rules, labeling, hygiene rules, or bureaucratic delays at the borders. What is this dismantling supposed to look like in practice? Both sides have committed to cooperation on the mutual recognition of standards for cars, food, and other industrial goods. If a product, for example, a car, electronics, or a meat product, meets the standards of one party, like the EU, it will be automatically recognized by the other party without new, lengthy, and costly tests or certifications at the place of import. American exporters, in particular, appreciated this. For example, the National Cattlemen's Beef Association publicly praised the Trump administration for the plan to remove barriers that limited the access of American beef to the EU. Is it really that revolutionary? The mutual recognition of standards, or mutual recognition agreements, also known as MRAs, is nothing new on the transatlantic axis. In the past, the US and the EU have signed similar agreements that were important for pharmaceuticals, machinery, and electronics, for example, and helped reduce costs, increase the speed of goods flow, and facilitate trade. In Europe, a similar principle, that if something is approved in one member country, it can be sold anywhere in the EU, has been a pillar of the common market since the early 90s. But be careful, the devil is in the details. Full mutual recognition is easier if countries have a similar level of economic development and comparable standards. For some products it works almost without problems, such as in engineering and appliances. But for others, for example genetically modified crops or especially treated foods, high barriers may remain. Past experience shows that the EU can be uncompromising on standards. An example is the negotiations on imports of American beef or chicken washed with chlorine. Formally, market access was allowed, but the EU set such strict rules that American producers often could not or would not meet them. The barrier was removed de jure, but de facto, it continued to limit the flow of goods. Removing non-tariff barriers is always one of the options to improve the efficiency of trade, reduce costs, and speed up the delivery of goods between the US and the EU. This agreement has a promising political goal, but its impact will only become fully apparent based on specific practice, the setting of technical rules, and the willingness of regulatory authorities to accept products according to truly equivalent standards. The result? In the short term, there may be a reduction in the administrative burden for companies, especially in standard sectors and for large exporters. But in sectors where the difference in rules is fundamental or politically sensitive, the barriers will likely remain, and the discussion about their real removal will continue in further rounds of negotiations. In the media frenzy surrounding the EU-US agreement from July 2025, a number was mentioned that was meant to calm Washington and the stock markets. The European Union promised to invest another $600 billion in the US by 2028. But when we start to break down this figure, a fundamental question arises: who is actually guaranteeing it? Where are the real investment commitments? When you look through the public statements of European companies and search for specific names that would really confirm the intention to invest such volumes of new money in the US, you will find that these promises are built on water. They are not legally binding contracts. They are mostly summaries of already existing investment plans or politically exaggerated estimates. The European Commission has admitted that the sum is more a summary of investment intentions that companies have already announced, and not something that Brussels could actually order the private sector to fulfill. In market economies, investment is decided by the market, expected returns, and demand, not by a political declaration. This approach gives the impression of a political game or a negotiating tactic. A large number is meant to de-escalate tensions before the introduction of new tariffs, and show the U.S. that the EU is a serious partner willing to support the American economy. Why does this suit Trump, too? The administration was under pressure to show domestic voters a victory, big money, new jobs, and foreign partners investing in the U.S. So similar numbers, even though they lack a precise calendar or enforceability, look good in political speeches and pre-election videos. Who are the potential investors? In energy giants like Total Energies, Shell, and BP have already invested in LNG terminals and renewable projects in the U.S. They may add more if demand grows or conditions remain favorable. In automotive industry, and German brands like Volkswagen, BMW, and Mercedes already have factories in the U.S. And after the new tariffs, they may expand their American capacities to avoid expensive exports from Europe, especially in the area of electric vehicles and batteries. For pharmaceuticals and biotechnology, and big names Bayer, Sanofi, Novartis, and Roche have long had research and production in the U.S. Some of the investments may go into development, clinical trials, or new production halls if regulatory conditions remain acceptable. And advanced manufacturing and technology, Siemens, ABB, and other industrial giants are strengthening American production, especially when it comes to digital technologies, AI, infrastructure, or energy. The reality behind the headline is that the true amount of new investments will be determined by the market, demand, and profitability trends. The political promise only warms up the atmosphere. The attitude of specific corporations will be decisive. Large numbers in political declarations serve more for immediate reassurance and communicating success than as genuinely enforceable commitments. European firms have been investing in the U.S. for decades, even without explicit political pressure. For many of them, the U.S. is the largest foreign market, and risk diversification remains the main motive. In other words, it can also be put this way: $600 billion. Sounds nice, but until a list of specific projects and contracts is published, take it as a political mood indicator and not an investment reality. More than new money, this is about the language of compromise that was meant to prevent tariffs and buy time for further real negotiations. If you've made it this far, you should know that this video is proudly sponsored by Lovable. It's a revolutionary tool that uses artificial intelligence to help you build modern web applications with just simple text commands. You can describe your app idea in plain English, and Lovable will instantly generate a complete working application for you, including the backend, a database, and a professional user interface. This makes app development incredibly fast and accessible, even if you don't know how to code. While it's a powerful tool for getting projects off the ground, a key thing to remember is its limits. For highly complex or specialized projects, you may still need to use its developer mode to manually adjust the generated code. So while it's fantastic for quick prototypes and minimum viable products, or MVPs, for a very advanced, custom-built application, some hands-on coding may still be required. If you have an idea for an app and want to see it come to life in minutes, you should definitely give it a try. Look for a link in the description, where you'll find my affiliate link. That's how we can continue making these videos. Lovable is a serious market player, represented by serious investors and valued at almost $2 billion at the time of making this video. One of the most discussed points of the EU-US Framework Agreement from July 2025 is the EU's commitment to buy an incredible $750 billion worth of energy products from the US, including LNG, crude oil, and nuclear fuel, over 3 years from 2026 to 2028. On paper, this means increasing annual imports to $250 billion, which is more than triple the value of 2024. Is such a goal even technically possible? In 2024, the U.S. only exported about $70 billion worth of energy goods to the EU. Even optimistic estimates say that between 2026 and 2028, the combined export of crude oil and natural gas could reach about $207 billion, still a long way from the political goal. Achieving the $750 billion goal would require reorienting a large part of the supplies from other countries like Norway or Kazakhstan exclusively to the U.S. This is highly unrealistic because European energy companies have long-term contracts, the infrastructure is optimized for nearby countries, and the European Commission doesn't dictate how much energy companies should buy from where. Here are the key barriers. Energy purchases in the EU are primarily determined by companies based on their own demand and prices. The Commission or a politician cannot directly dictate the volume, they can only recommend or motivate. U.S. export capacities is increasing in its export infrastructure, especially for LNG, but even the new terminals being built are expensive and won't be completed for another 2 to 3 years at the earliest. In 2025, American LNG terminals are already operating at full capacity. For nuclear fuel and reactors, the U.S. itself imports most of its raw uranium, and the export of small modular reactors is still more of a vision than a reality. Over the last 5 years, the export of nuclear equipment from the U.S. has been only a negligible fraction of the agreement. It depends on energy prices as the goal is set by value, not volume. Therefore, only an extreme rally in gas and crude oil prices could theoretically help it, but that is also an undesirable scenario, especially for consumers. And as for European infrastructure, in recent years, the EU has strengthened its LNG capacities, which reach about 250 billion cubic meters per year. Western and Northern Europe have the most access to the sea and infrastructure, including Spain, France, the Netherlands, Belgium, Italy, Germany, and Poland. Even with this capacity, however, the real volumes of imports from the U.S. are limited by market demand, competition from other suppliers, and long-term commercial contracts. We may be repeating ourselves, but this is a political agreement or framework that hasn't even been finalized yet, so it's more about the political advantages of presenting an agreement, especially for Trump. Only he can declare a trade war on the world, then declare a pause to get agreements that have no legal basis even in the U.S. Senate, only through a presidential directive, so it can be described as. The political commitment to buy for $750 billion is more a symbol and a sign of confidence than an enforceable plan. Given the real market capacities, valid contracts, and logistics, it is unattainable in the coming years. To actually import such volumes would mean dramatically changing the structure of European demand, disrupting contracts, investing massively in infrastructure, and significantly overpaying for supplies. The focus of decision-making will continue to be the market and the private sector, not a political declaration. This practically comes down to the U.S. attempting to conquer the European energy market. One of the most technically important aspects of the EU-US Framework Agreement from July 2025 are the so-called Rules of Origin, or ROLO. At first glance, they sound boring, but in practice, they decide which products will be favored, and which, on the other hand, will remain behind a tariff barrier. What do the rules of origin in this agreement mean? The rules of origin determine in which country a product was truly made. This is crucial because tariffs, trade quotas, and public procurement are tied to where the goods originate, not according to the place of final assembly, but according to where a substantial manufacturing transformation took place, or where a decisive percentage of the value was created. In trade between the EU and the US, where the US is introducing a 15% tariff on most EU goods, and the EU is abolishing tariffs on American industrial goods, The ROO decide which country and which product will get an advantage. If the condition of the share of domestic components is not met, the product may end up outside the discounted rate and cost much more. Preferential rules of origin are determined separately and in detail for each trade agreement. Sometimes a substantial transformation is recognized, other times a minimum percentage share of inputs, as after Brexit, where a minimum of 40% of car parts had to be from the EU or UK, otherwise a 10% tariff was applied. Who will this affect the most? These rules have the most significant impact on sectors with complex and global supply chains, especially the automotive industry, and the production of batteries for electric vehicles. For example, after Brexit, vehicles exported from the UK or the EU must meet a certain share of domestic production, otherwise they face a higher tariff. The question is how the rules will be set in this transatlantic agreement. If a strict share of European or selected components is maintained, European and American companies will have to move production, otherwise they risk losing market share or incurring higher production costs. This is most problematic for electric vehicle batteries, as many raw materials still come from Asia, especially from China. If the requirements for the share of domestic material are not met in time, each car can become significantly more expensive. How will this affect production chains in practice? Mainly as pressure to localize. Companies, especially in EVs, technology, and the automotive industry, will be forced to move more components and production processes to the EU or the US to maintain a more favorable status. This can cause new waves of investment, known as reshoring, but also an increase in costs and prices. The next goal is changes in sourcing. Especially for batteries and modern technologies, sourcing will need to be adjusted so that more material comes from the European or American area. And raise costs and competitiveness. In sense, if companies do not meet the origin threshold, they will face new tariffs. These will either be passed on to the customer in the form of a higher price, or will put pressure on lower margins and reduced profitability. The rules of origin in this agreement are not dry legislation. In the real world, they will influence whether a new electric car, smartphone, or medical technology will be able to cross the Atlantic without fees, or whether importing will become unprofitable for a company. Their development will be key to where companies open new factories, from whom they buy raw materials, and how quickly the network of suppliers will change throughout the EU and the US. It is here that the hidden struggle between global chains and new economic borders will lie, from supply strategy to the final price for the consumer. The EU-US Framework Agreement is formally a, quote, political agreement, not a legally binding treaty. Its implementation and enforceability depend on whether the individual commitments fall under the exclusive competence of the EU or the shared competence of the EU and its member states. So when does the European Commission decide, and when are other approvals needed? The European Commission has the mandate to negotiate agreements on behalf of the EU, especially where the EU has exclusive competence, typically in the areas of tariffs, trade barriers, and standards. The Commission itself leads the negotiations, but the mandate is approved, and the agreements are concluded by the Council of the EU. The Council of the EU is always part of the process, approving the mandate for the Commission, the negotiations, and the subsequent signing of the agreement. If it is an area that falls exclusively under the EU, such as customs policy, under Article 207 of the Treaty on the Functioning of the European Union, the consent of the Council and the European Parliament is sufficient. The European Parliament must give its consent to agreements falling under the exclusive competence of the EU. In other cases, it has an advisory role. And what about the national parliaments of the member states? If an agreement also affects areas of shared competence, for example, consumer protection or the environment, it is a so-called mixed agreement, and its ratification is also mandatory in the parliaments of all EU member states. The process that such agreements go through is usually significantly longer and more legally complex. What can't the Commission unilaterally enforce? The purchase of military equipment falls under national sovereignty. Each country decides on its own military budget. The Commission can only coordinate. It cannot order any central purchases. The Commission or the Council cannot order European companies or countries to buy energy commodities exclusively from the US. The market, the companies themselves, and already existing long-term contracts with other suppliers, such as Norway or Kazakhstan, decide. Similarly, with investing, the Commission has no authority to tell private companies from Europe specific amounts or directions of investments in the U.S. These are voluntary decisions, not legally enforceable commitments. If harmonization or interventions in the laws of member countries were necessary, for example in the area of standards or public procurement beyond European harmonization, it is ratified in national parliaments according to national law, for example, by two chambers, or federal versus regional approval. Although the Commission has a strong mandate in the area of tariffs, technical barriers, and trade policy, all other extensive commitments, including energy, defense, public procurement, and investments, are in reality non-binding and require the willingness of the member states or the decision of specific companies and subsequent national ratification. That's why the most ambitious points of the agreement that have become part of political communication are often only declarative in reality or dependent on other levels of approval. The fulfillment of these points affects not only Brussels but also national governments, parliaments, and the corporate sector throughout the EU. That's why the Framework Agreement provides an immediate political signal, but its real effects and enforceability will only be seen after further rounds of negotiations and approvals. In 2018, the U.S. administration started an era of trade conflicts by introducing 25% tariffs on steel and 10% tariffs on aluminum from the EU. This affected European exports worth €6.4 billion. The EU responded with countermeasures on goods worth €2.8 billion from the U.S. Uncertainty increased significantly, and companies postponed investments and changed their chains, regardless of the fact that the negotiations at the time did not ultimately lead to a complex and ratified agreement. The impact on the markets was noticeable just by the announcement of the tariffs. Price changes, supply disruptions, and lower profitability for industry and agriculture. Economic experts warned that the escalation itself, without a legally binding treaty, could significantly affect business behavior and confidence on both sides of the Atlantic. The current agreement from July 2025, on the other hand, is perceived mainly as a way to prevent a similar escalation, specifically averting the 30% tariffs that were a real threat. Its immediate effect is that it reduces uncertainty in the markets and allows companies to plan with a little more predictability. Although the new tariffs, 15% on European goods to the U.S., are higher than before at 1.2%, through political declarations and promises of investments in energy purchases, the agreement sends a signal of stabilization, which temporarily limits volatility. Another significant historical parallel can be found in the WTO dispute. A relevant precedent is the hormone-free beef dispute between the EU and the U.S. Although the U.S. won the arbitration at the WTO, in practice, the EU enforced such strict technical conditions that American producers did not rush to the European market. The allowed quotas were filled by countries like Australia or Uruguay. De jure, the market was open, but de facto, it was not. The U.S. and EU economies are simply very different, and it was not and is not profitable for farms in the U.S. to rebuild their business to the European one to meet and pass the administration and get certifications. Australia and Uruguay, however, managed to do it. So those regulations were not very high, but they were perhaps very high in relation to the functioning and regulations of businesses and farms in the U.S. The same mechanism is a threat today. The political framework agreement contains high paper commitments, such as energy purchases and investments, but their implementation depends on market behavior and the details of the standards. If European companies don't find a reason to buy enormous volumes of LNG from the U.S. due to price, infrastructure, or contracts with other partners, the goal will remain only a declaration. For investments, if the conditions on the American market are not attractive enough for European companies from the point of view of profitability, the declared sums will not flow into the U.S. And for non-tariff barriers, the EU can continue to enforce such regulatory or standardization requirements that, for many American products, the EU market will remain de facto difficult to access, and vice versa. It is also worth mentioning that these conditions and details are still to be negotiated. The fact is, however, that many European politicians have criticized the agreement or the framework. And Ursula von der Leyen is accountable to the European Parliament, just like the European Council, or the European Parliament is accountable to its voters. And President Trump does not have the most appealing approach and behavior towards Europeans. Ursula von der Leyen is thus under pressure from the US and the EU, but at the same time, she must please the national policies of the 27 states. there is a high chance that this agreement will not be enforced, even if some elements may actually be applied. The framework agreement with the EU from July 2025 serves President Trump primarily as a political weapon, a tool for his own PR, maintaining the image of a strong negotiator and appealing to voters. His rhetoric targets emotions and strong winning narratives, even at the cost of simplifying or misleading about the real content and conditions of the agreement. Although the agreement stabilizes the markets in the short term, in the long run, much remains only on paper. But for a political campaign, the immediate effect and successful marketing are most important. It also helps him in building a personality cult. The question is, however, if this is his last administration, why would he do it? One of the key aspects of the EU-US framework agreement is the energy package, a huge commitment according to which the EU will buy $750 billion worth of LNG, crude oil, and nuclear fuel from the US over 3 years from 2026 to 2028. Although the real feasibility of this goal is questionable, its symbolic weight is very strong, and it has several geopolitical layers. Is the US also reacting to Canada's ambitions with this step? Yes, indirectly and strategically. With this step, the US is clearly trying to strengthen its position as the main transatlantic partner for Europe's energy security, especially after the move away from Russian raw materials. The exclusive commitment thus naturally reduces the space for other players in the market, and Canada is one of the countries that has big export ambitions toward the EU. Canadian LNG projects, for example, LNG Canada in Kitimat, British Columbia, are directly aimed at expanding exports to Europe, with the largest new capacities coming online after 2025. A significant deal was concluded at the end of July 2025 by the Canadian company Tourmaline Oil Corp. And Uniper from Germany, an 8-year contract for gas supplies starting in 2028. The Trump administration and its bilateral strategy openly hierarchizes partnerships. The EU has a preferred position, while Canada, as well as other states like South Korea and Brazil, face the threat of import tariffs of 25 to 50% on the American market. With this agreement, the US is making it clear who the preferred customer is. Is there clear evidence that the US wants to directly weaken Canada? There is no explicit evidence of this in the available sources. No official memorandum or direct mention in the leaders' communications. However, the specific setting and strategic context show that gaining the largest possible share of the European energy market is a clear intention. The US wants to be an energy superpower, and gaining exclusive commitments from the EU means that competitors, whether Canada or other exporters, will objectively have a harder time succeeding in the market. Preferential treatment of the EU and the tightening of conditions for countries without such an agreement, such as higher tariffs and uncertain quotas on the American market, naturally favor the US as a key player and squeeze other exporters into a less advantageous position. The Canadian reaction was cautious. The Canadian government and media reacted with restraint, with an emphasis on the fragility of putting all hopes into quick bilateral agreements with the US. The Canadian approach is principled and rather conservative, rather no agreement than a one-sided, disadvantageous treaty which, in their opinion, the EU accepted. At the same time, Canadian companies are trying to diversify exports and conclude their own contracts directly with European partners, so that they are not pushed out by the exclusivity of American supplies and the political strategies of the big players. However, it is important to note that Canada is a very important energy supplier to the US. A few numbers from 2024 to think about. Canada is by far the largest source of crude oil imports to the US. As much as 61.7% of all crude oil imported into the US comes from Canada. In the total volume of hydrocarbons that the US imports, Canada accounts for as much as 70.2%. This relationship is mutually beneficial, as much as 94.4% of Canadian hydrocarbon exports go to the US. The US's dependence on Canada for natural gas is almost complete. Canada supplies almost 100% of all natural gas that the US imports. This gas flows through extensive pipeline networks that connect the markets in Canada and the US and ensure stable supplies, especially in the northern regions of the US. Canada is also the main source of electricity imports to the US, providing 81.6% of total imports in 2024. Although this import accounts for only 1% to 2% of total electricity consumption in the U.S., it is crucial for the stability of grids in border states such as Maine, New York, Minnesota, and Washington, where it can cover more than 40% of their consumption. It also doesn't have to be just an announcement for Canada, but also for other players, for example, India. However, it is important to note that if Canada fulfills its goals, it is a great security threat to the U.S. At the end of this chapter, it looks more like the European Union wants to be more like the Phoenicians. It doesn't matter what's happening, as long as there is trade and diplomacy. These are dangerous times when the EU and the European Commission must primarily make decisions based on the conflict in Ukraine and the fact that China, due to overproduction and a communist competitive political system, must and will export more to the EU, while it is clear that Americans will not be able to afford to buy more and more European products or services. According to estimates, as a reminder, this could mean the loss of up to 10,000 jobs for every €1 billion loss in exports to the US. The EU is between a rock and a hard place, but it still relies on trade, diplomacy, and soft power in the form of regulations and the so-called Brussels effect. And what do you think? I'm not trying to judge who is winning and who is losing. That would smell too much of mercantilism. Rather, I would like to draw attention to the serious and perhaps even dangerous position Europe finds itself in today. Should we have reacted sooner and more decisively, similar to Canada or China? Do you think this trade agreement will even be approved? And what do you expect from a market that, as we have shown, is already facing serious challenges and is likely to face even more? Share your opinion in the comments. It's unlikely that a formal EU-US agreement will be signed, but its provisions can still be implemented without one. The idea of a free energy market in the EU is largely a myth. Despite market mechanisms, the main dynamics are driven by states through two key channels. The first is ownership and voting rights, with examples like Slovenské elektrárne, where the state influences strategic decisions even without a majority share, or the fully state-owned French EDF and Italy's Enel, where the Ministry of Finance holds a significant stake. The second is control of infrastructure, as states own, co-own, or have managerial control over key transmission systems, gas pipelines, and oil pipelines, which gives them immense power. This shows that trade agreements aren't just a matter for the European Commission. A prime example is Slovakia's $15 billion agreement with the American company Westinghouse, which demonstrates that the U.S. can advance its goals through bilateral deals. And when the fourth or fifth poorest country, according to Eurostat's net income per single person without kids, can contribute 2% to the declared energy trade goal, there's a strong chance that those goals, while ambitious, are not unattainable. However, the Slovak Republic has not directly signed a trade agreement, and construction has not yet begun. It is, shall we say, an intention or a memorandum from the Slovak Republic, and this is its estimated value. My explanation of tariffs, trade agreements, and their ultimate impact is that, honestly, I just don't know for certain. It depends on a multitude of factors: the specific sector, the product, the time horizon, and even the product lines within a given sector, which relate directly to the competitive environment. There are simply too many variables. That's why, if you're truly interested, it's best to look at markets individually, not just by sector, but perhaps even at the level of the products themselves. Take the example of the U.S. sanctions on solar panels. Did they halt employment or slow down the market? Yes, they did, but within just 2 years, employment in the sector was growing again. The market simply adapted and moved on. On the other hand, let's consider food and farmers. Yes, sanctions can certainly affect prices, especially from the perspective of energy costs or various sprays. Will these costs be absorbed by everyone in the supply chain? Absolutely. But will consumers actually see this reflected in the final price of the products? The answer is, I don't know. This isn't just a political issue, it's a technological one. Will people look for new methods and adopt new or old technologies and knowledge to avoid increasing costs for seeds or fertilizers? Yes, they will, and they may have already tried. Furthermore, various farming joint ventures might form to secure more favorable conditions. My core point is that the market always finds a way. I would personally avoid broad statements like, tariffs will generally increase prices and hurt competitiveness. While those statements are factually true in principle, they are also a simplification. The final outcome depends on many factors, including the flexibility of the product or service, the market's dynamism, innovativeness, and consumer behavior within those sectors. It also depends on the supply chains and the existing infrastructure. Some things can't be changed, others can, and some may no longer matter. As a result, the final impact might make it seem as though tariffs didn't increase prices or reduce competitiveness, but that wouldn't be the full truth. Ultimately, based on a simple general fact, markets are forced to act, and this can cause the impact of tariffs to be so minimized that, in various macroeconomic, microeconomic, or impact studies, the effect appears to be negligible. While I can't predict the general impact of tariffs, and I wouldn't even venture a guess on a sectoral level, what I am thinking about is a different question. Will these tariffs halt small and medium-sized businesses, or will this be their springboard to bounce back? Will the big players get bigger and the small ones get smaller? While I might not be able to tell you the impact on prices, it seems to me that the biggest beneficiaries of the market's reaction to these tariffs will be the big players, and that's not a good thing. Ultimately, my view is that this agreement is neither in the spirit of Adam Smith, a win-win scenario, nor in the spirit of mercantilism, where there is a winner and a loser. Instead, I see it as a lose-lose situation, mainly because it lacks what a mercantilistic approach needs: control over others or colonial power. The fundamental purpose of any trade or trade agreement, going back to the days of bartering, is either to create value or to satisfy a need. In this case, neither the US nor the EU has truly won. The US, in terms of creating value or satisfaction, will either face higher prices on certain products, or the price will remain unchanged while the quality drops. This could lead to more frequent and necessary purchases. Consequently, neither the creation of value nor the satisfaction derived will be what it once was. The only aspect of this situation that resembles mercantilism is the use of tariffs in Trump's public statements about billions of dollars flooding into the state budget each month. This is precisely what Jean-Baptiste Colbert, a leading figure of French mercantilism, would have said. The state's wealth is paramount, even if the people suffer. It is a flawed theory. But to implement it in America, where it's almost guaranteed that the common people won't see the benefits of those billions, yet some will still applaud it, strikes me as profoundly ironic. On the other hand, the EU, especially under the influence of China, will lose out on creating value, which will subsequently affect satisfaction. This could manifest as a smaller selection or lower quality products from China. While removing some barriers or regulations regarding product origin can help, in a fragmented and mercantilist global market, it simply means that supply chains and infrastructure will not be able to fulfill their potential. To put it more simply, imagine you have a ball and a racket, and your goal is to hit a target. You discover that even though the ball is perfectly designed for the racket, the material is weak and bends. The ball isn't firm enough on impact, and you waste minutes and hours just trying to hit the target even once. While my approach is more fundamental than that of an expert, the devil truly lies in the details. If you want to know the exact situation for your specific sector, product, or service, or are simply curious for educational or investment purposes, I can offer you a roadmap. My basic advice is to look at the Purchasing Managers Index PMI and focus on new orders. By analyzing this data, you might discover emerging sectors or new countries with which the EU has no tariffs. This is where you might find a hidden gem, a source of true value that could help the EU turn this into a, quote, win-lose scenario, if we still want to play a game of winners and losers. Which leads me to another topic, and that is double standards. Criticism of prime ministers like Fico and Orban is deserved, but the project and history of Germany's Nord Stream 2 are often forgotten. Despite warnings from security experts after the 2008 invasion of Georgia, Germany completed the project in 2021 because its economy depends on cheap energy. The project was accompanied by widespread corruption, with former German Chancellor Gerhard Schroeder as its biggest symbol. After leaving office, he became the chairman of the supervisory board of Nord Stream AG and later also of Nord Stream 2 and Rosneft, earning almost $1 million a year. This led to the term Schroederization, which refers to the corruption of a country's political elite by another. The project was only criticized by the Baltic states and Poland, which points to a double standard when assessing political decisions within the EU. And why am I discussing this now? Mainly because that policy and individual political steps or statements are judged by double standards, even within international politics in the EU. European politicians have often criticized Russia or China for propaganda and weakening the EU, especially in connection with Brexit. However, it's also important to see the role of the United States. The organization Cambridge Analytica, which was involved in the campaign for Brexit, was financed by the American billionaire Robert Mercer, a close ally of Donald Trump and Steve Bannon. People like Mercer and Bannon, who are very influential within the American Republican Party, have long been trying to support right-wing populist movements in Europe as well. Bannon, for example, founded the Movement organization in Brussels in 2018 to coordinate far-right parties in the EU. The connection to the American environment can also be seen in the spread of QAnon conspiracy theories, or through funding from American conservative organizations. It is interesting that while European politicians were quick to react to Russian hybrid threats, they often overlooked equally documented activities by American actors. Newer steps by the American administration under Trump show direct pressure on the EU. For example, Vice President J.D. Vance accused European leaders of using Soviet words, like disinformation, and restricting freedom of speech, while other American officials introduced visa restrictions for European officials. The American administration often criticizes the fines that the European Union imposes on American companies, calling them a form of, quote, economic extortion. As a result, it even threatens to impose tariffs on countries that fine American companies. This harsh rhetoric and threats are also related to fundamental differences in legislation on freedom of speech. While in the United States, the concept of absolute freedom of speech applies, that is, with almost no restrictions, the European Union approaches freedom of speech more liberally, with a greater emphasis on protecting the rights of others and public safety. In the EU, freedom of speech must not violate the rights of others or threaten their dignity or safety. This difference in approach is reflected not only in the area of content regulations, but also in how individual legal systems handle sanctions and fines companies. American lobbying groups and corporations actively influence EU legislation, which can be seen, for example, in lobbying against climate laws and digital regulations, where American fossil fuel companies have invested millions of dollars in anti-climate campaigns in Europe. However, in my opinion, it is even sarcastic to note that these EU regulations largely help technology giants because they can cause problems for their European counterparts if there is no robust capital market in the EU, as there is in the US. Skepticism towards the World Trade Organization, or WTO, and the use of tariffs is not just Trump's policy but a long-term strategy across American administrations, including Bush, Obama, and Biden. This approach is also motivated by the economic reality of the US, which has a huge debt of $36.2 trillion. Tariffs and duties are becoming an important political pressure point, especially due to the absence of reforms, but also a source of revenue. The Congressional Budget Office estimates that tariffs could bring in $2.8 trillion over 10 years. Given this financial reality, it is unlikely that future administrations will abolish them. This presents a major challenge for the EU and its businesses. Also, in the past, the so-called tax cuts that Trump first introduced were not repealed by the Democrats even though they tried. This could be significantly related to the budget and the decision of a future U.S. administration not to repeal tariffs. The European Union thus finds itself in a difficult geopolitical position. While it relies on its regulatory power, the U.S. maintains a dominant influence, and China is strengthening thanks to a hybrid economic model. This puts the EU in the role of a pawn on the chessboard. The real path to European autonomy does not lead through seeking new, protectionist markets like India, but through a massive strengthening of its own internal market. If the EU has similar ideals to the Phoenicians, then the US and China are becoming Alexander the Great or Rome, especially at a time when every bloc is starting to apply old mercantilist theories. A key problem for the EU is its underdeveloped capital market, which is hindering the growth of its companies and economy and their ability to succeed on the world market. This issue is reflected in alarming numbers. American venture capital investment is almost 3 times higher than in the EU. The average value of a successful American company is more than 10 times that of a European one, and the market capitalization of the S&P 500 is many times higher than all European markets combined. This creates a vicious circle. Wealthy European investors prefer to invest in American companies because they have immediate access to both the US and EU markets, and thus a better model for valuation and growth. In contrast, European companies start with only a fragmented market with insufficient support. As a result, European investors have no need to invest in European companies that could compete with their American investments. The dominance of the American market is not solely based on fundamentals. The GameStop case has become an iconic example of how the power of retail investors and social media can drive market value far from business reality. Similarly, Tesla is the world's most valuable car company, despite its sales and profitability lagging behind traditional giants. This is largely the result of Elon Musk's unique marketing and PR, which has positioned Tesla as a futuristic technology company. For example, investors expect future profits from robotaxis, arguing for a massive cost saving from eliminating human labor. It's no wonder that a value investor like Warren Buffett avoided Tesla, choosing instead to invest in China's BYD, which has already surpassed Tesla in sales. This suggests that marketing and PR, driven by a complex mix of capital market players, have a major impact on valuations. My key intention in this is to build a snowball effect, and my idea to achieve it is through a multi-pronged approach. First, a solution could be the regulation of investment and pension funds, which would oblige them to invest a proportional part of their capital in European companies. Although this could be seen as part of trade wars, it is an important step, especially in times of global economic tension. I don't like artificial restrictions, and I know that such measures can reduce the performance of pension plans. However, in the US, there aren't many funds that would invest heavily in European stocks. The problem is not that European stocks lack potential, but that the American capital system significantly favors American stocks. The next step should be tax breaks and incentives for investors, including small retail investors, that would increase demand for European stocks. This, however, requires close cooperation between the member states. No less important is the completion of the Capital Markets Union project, which has been unfinished since 2014. It is an infrastructure for capital markets. If you have a factory but are not connected to highways, it will be difficult to sell and export. Various types of capital market levels could also be built. For example, for strategic funding of research and development, or farming entities. Such an approach could ensure liquidity and funding directly from the market, while also securing a share for investors. For food producers, this could lead to mergers and acquisitions, increasing their leverage against wholesalers. Ultimately, while an IPO provides liquidity and funding, being publicly listed can also attract significant marketing and PR, and ultimately draw in more businesses for research collaborations or as future trading partners. The key is to first raise funds, and then use the marketing power of the capital markets to attract partners. A potential problem for these new markets, however, is that in the medium to long term, the costs associated with listing on these specific capital market tiers could become prohibitive. The last thing which could also boost the European market, even without the Capital Markets Union or some tax cuts, could be the digital euro. It could force banks to focus more on investment banking than traditional and safe banking. The EU is critically dependent on China for mineral extraction and on the US for technology. It lacks its own digital platforms, such as search engines or large language models for artificial intelligence, cloud infrastructure. European research, often financed by public funds, paradoxically becomes a source of innovation for American companies, which then patent and commercialize them. Europe does basic research, and then USA take it and researches it for business needs. The solution is strategic support for our own research and development. It is necessary to invest in areas such as synthetic materials and new energy sources like sodium-ion batteries to reduce our dependence on critical raw materials. These steps must be supplemented by support for innovation to ensure that the results of European research are actually converted into commercial solutions, rather than being utilized by American companies. My fundamental finding and personal opinion is that reglobalization, that is, the diversification of markets, is not necessarily a bad thing, as some experts claim. However, in the short and medium term, it will negatively affect growth and people's quality of life. I can't tell you the specific ways this will happen because too many unexpected things occur in the world. Who, for example, would have thought a few years ago that Yemeni militias would start attacking ships in the Red Sea, disrupting global trade? It is also questionable whether new markets will not continue to operate under a mercantilist system in the future. Relying on exports was once a sound strategy, especially after an economic restart, such as in Europe after the Second World War. It seems to me that for Germans, exports have been key, even from a long historical perspective, for example from the time of Frederick the Great, who aimed to transform military power into economic power by sending spies to Britain. Unfortunately, that will probably no longer be sufficient, especially as technological advancement in other states is rapidly accelerating, and a century-old German brand may simply not be enough for the future. My geopolitical findings and the fundamental reason why we should focus on our own market is precisely this. Exports should not be the most important driver for the EU economy, and they are also dangerous. The best engine for market growth in the EU is especially the internal market and the capital market. For example, Google paid its employees over $22 billion in stock-based compensation in 2024. This not only creates liquidity for companies through IPOs but also for their employees. And, of course, it generates higher state revenues, which may help not only with the aging gap situation, but also with conservative consumption in the EU compared to the US. Furthermore, if we consider the historical development of US and EU capital markets, specifically the world wars and the divergent paths taken from the 17th and 18th centuries, it is clear that there is a lot of work to be done. The EU has therefore not had centuries to build a strong, diversified, and business-focused capital market, and that means we could see rapid results and quick investor satisfaction. We don't have to have the most prominent banks or various energy or pharmaceutical companies on the exchanges. We can have technological and retail IPOs, for example, from companies like Kaufland, Lidl, Aldi, and Decathlon. And they don't have to have a free float of 80 to 90%. They can have even less while maintaining control and a majority, just like the Volkswagen and Porsche families. If you enjoy shopping at the Action retail store, imagine if you had employee stock, or could buy shares in this still developing chain that is fast expanding in Europe. And not just these, but also companies like Mistral AI, if you want to focus on technology. The growth from an IPO perspective alone should be significant. Developing a European-owned cloud infrastructure would be of critical importance to the EU due to its current reliance on the infrastructure of companies like Amazon and Google. Possible problems that large investors would immediately raise with the EU market would be, for example, strict laws for employee and consumer protection, but that's exactly where the strength should lie. If a company can handle these highest standards, it can handle the whole world too. Besides, if strict laws were truly a barrier, then NVIDIA would not have been able to achieve the results it has without ASML's products and their ability to develop them, as ASML is an EU company. So it's foolish to claim that such laws limit the possibilities of the capital market or business in the EU, even though their influence is clear. For me, these are, to a large extent, lobbying statements. Just a small insertion for your imagination. Also about how marketing and PR of capital markets can work in the United States. If a company like NVIDIA has a valuation like the largest economies in the world, while the company it technologically depends on is worth a few $100 billion, then there is a double standard somewhere. ASML, however, does not indirectly serve only companies like NVIDIA, but also Apple and others. In contrast, if we believe that NVIDIA will monetize from AI in entirely new sectors, and the difference between the two companies is that ASML is a manufacturer while NVIDIA is a designer, which should have a higher valuation, then what about Google or ChatGPT? They are in-sellers, which should have a far greater valuation than the trillions NVIDIA has. Personally, I doubt that NVIDIA truly has such a value, but American stocks are known to be valued much higher than, for example, Asian, Japanese, or European ones, simply because they are on an American exchange. The biggest problem I see is that often, the wealthy European private sector, funds, or individuals simply prefers to invest in American companies because they know they will also get the European market. It therefore makes no sense to invest in European startups that would only unnecessarily compete with American investments. And often, even if they do, it's with the goal of selling to an American company. This applies especially to companies that quickly copy US startups and make a European version. The goal of a later sale to that American startup, in my opinion, is screamingly obvious. And these problems are also related to the so-called brain drain, where people who feel they should have greater opportunities go to US companies and organizations. As I mentioned with the monetary possibilities of the American and European central banks during the debt crisis, the capital market is key in terms of the possibilities of monetary policies, sobering up, and starting growth after crises, which is also related to debt and managing geopolitical and economic challenges. If the central bank is the Habsburgs, then the capital market is the Fuggers. And about the geopolitical findings. If we have powers, for example, like China, China is a very strange model that functions hierarchically, but at the same time not. A fundamental finding, if we take all possible theoretical and practical findings from various economic theories, is that China will have to reform. The reason why China is moving forward and becoming a global leader is not related to the latest economic theories or theories that have been proven to be true. China, within its communist political system, operates through a form of competition. Regional politicians compete to get into the center of power, so they have to invest and employ people. However, regional possibilities are limited, so they export. A real example that you probably know about are the so-called ghost cities in China. No one lives in them, but they ensured employment and investments. And this is related to overproduction. And since the market is not enough, China has to push harder, for example, with price, and so it gives these companies subsidies. That's why products from China are super cheap, not because the Chinese create poor quality products or because they have low wages. It is related to subsidies and quantity. If companies get subsidies, and at the same time sell not 1 million products but 10 million thanks to lower prices, they can achieve a small profit. The problem is that these companies in China compete with each other mainly for political reasons. They want to get to the center. This struggle is also in the area of development, not just production, which creates more and more overproduction, and the system of subsidies and low prices will not be enough. Because if China's successful product is, for example, electric cars, those regional politicians also want to create successful car companies in their region. If a successful region sells, for example, a menu for restaurants to the world, other regions want to do the same. This is essentially a ticking time bomb from the perspective of world trade. For this reason, it can be argued that China is not a world power in the traditional sense of the word. They have not yet completed the development of their policy and economy. And the change will most likely be painful for China. And this change will not be caused by tariffs, as Trump wants. This is the reason I believe the world will fragment, with nations trying to protect themselves by raising barriers and tariffs. The second power is the U.S. The U.S. is exceptional in its economy, and it has reached the maximum possible level of development. Within economic theories, the goal is to ensure that the internal market is strong and resilient. However, if an economy depends more on exports, it means that the internal market is not strong enough to absorb such a quantity. The U.S. can therefore absorb imports from all over the world and actually sell them within its market. There is no such economy in the world that would meet this, shall we say, highest goal of economic theories. This phenomenon is accompanied, for example, by the system in the U.S. With no wars on U.S. territory, the capital market in the U.S. in the beginning was not only for large companies, but also a way to build large companies. That market, that complexity, from the point of view of numbers, is the most developed in the world. The problem, however, is what is behind it. The U.S., for example, does not have a public system of healthcare, education, or even pensions like other developed countries. It is actually the only one in this regard. They have some systems, but they do not work automatically for all citizens. The system of functioning is different, which is also related to credit scores, credit card debt, or, for example, student loans and medical debt. In the U.S., there are even crowdfunding platforms through which medical debts are paid, and they are growing every year. If I was talking about the regulation of pension funds, for example, the American 401k system contains only 5 to 10% in foreign stocks, despite the recommendations of world funds. It is, therefore, more of a national thing and an economic speech home bias. The U.S. is therefore very focused on individualism and his or her own ability. In real life, however, you do not get abilities or maximum potential just by trying, and not everyone has the same starting point. This applies to the whole world in general, but in America the emphasis on success and competition affects the system, and not only from the point of view of future work and the quality of life as such, but also in the sense of social or various modern trends, which are amplified by the consumer system. The problem, however, is that if those who are not given a chance by the system, and are not supported to maximize their potential and the success that is so important in the U.S., the macroeconomic consequences can be fatal. The equation for the U.S. is simple. If the share of these unsuccessful people increases, the U.S. will not be able to manage its own political and economic systems. The U.S. often uses foreign talent for this, but due to protectionist and national policies, this equation cannot be compensated for, and the holes that are not macroeconomically or market-wise visible will grow, and this will be very destructive for the world. A famous saying says, if the U.S. sneezes, the whole world gets the flu. Even the judicial system works differently in the U.S. than in Europe, and can be realistically inaccessible to a large part of the population or smaller companies. The main reason is that in the U.S. there are two parallel judicial systems, federal and state courts, which have different jurisdictions, approaches to laws, and often completely different decision-making practices. If a company or individual is dealing with a lawsuit, the analysis itself of where and how to proceed requires the involvement of expensive lawyers. They must accurately analyze the chances, choose the most suitable jurisdiction, a state versus federal court, search for suitable case law, and construct the best argument, often with the aim of dragging the case into a more favorable court. The high costs, complexity, and demands for legal expertise mean that for ordinary people and small businesses, enforcing their rights in the U.S. is much more expensive and complicated than in the EU. The U.S. has built a system of strong individualism, often promoted through propaganda. This can create powerful human capital, but in doing so, it has failed to limit the power of financial capital. This unchecked financial power will inevitably restrict the opportunities of others, a fact made obvious by the lack of social safety nets or types of protections for everyone. The system, in effect, empowers financial capital at the expense of its own people. These systemic cracks, though perhaps not yet fully visible, are the reason why the U.S. will continue to use trade wars, tariffs, and its influence to foster trade. That is why I do not think it is wise for EU companies to continue to rely on the U.S. market. Instead, they should diversify and research for technologies or even product lines. One of the main things I've realized is that the strategies of China and the U.S. are remarkably consistent. They may take decades to unfold, sometimes more visibly, sometimes less, but the commitment to a long-term goal remains. In Europe, it's a different story. We saw research papers from the early 2000s highlighting the critical need to diversify energy suppliers, yet it never truly happened until the war broke out. Germany, for instance, seemed to want even greater dependency on Russia, despite clear warnings like the invasion of Georgia in 2008. The response was simply to build more pipelines. This is not an isolated issue. It applies to green energy and other sectors as well. In Europe, it seems politicians often do what is popular at the moment. There's no genuine strategic vision, even though numerous papers and research exist on the topic. The core issue, in my opinion, is our fragile politics, where populist movements and a desire for quick solutions often take precedence over a patient, long-term strategic vision. And I am not really very optimistic about this. So I decided to learn more, share it with you, and maybe we can change something together. To conclude, I would like to remind you that while research and development is indeed the solution for the EU, it must be research that is effectively turned into a successful product or service. Without a large capital market and a change in mindset, there is a very high chance that the crises in the EU, which have been with us since 2008, will only continue. And if the EU lacks that engine of growth, it risks ending up like the Weimar Republic, especially with support and campaigns from Russia or the US. Conversely, even if it has that engine, but the EU is not decisive against external geopolitical efforts, even from defensive allies, it risks ending up like the Phoenicians. At the end of each of our videos, I'd like to highlight interesting new startups or organizations, with a focus on those from the EU. And since this is our very first video, it's none other than our sponsor, Lovable. It's a Swedish AI-powered software startup that was founded in Stockholm in 2023. Lovable is known for its vibe coding approach, which enables non-coders to build websites and apps using natural language inputs. The startup has achieved rapid growth and has already reached unicorn status. Thank you for watching!